Welcome to the European market open a minute to go until the start of cash equity trading. I'm Tom Mackenzie in London, and here are your top stories. Seeing a dovish turn, stocks and treasuries rally on optimism that aggressive rate hikes by the Fed are nearing an end. Chinese markets surge on speculation the country may exit stringent COVID restrictions. The long, unwinding road. The Bank of England becomes the first major central bank to start quantitative tightening. Downing Street, meanwhile, says higher taxes are on the way. And bumper energy profits, oil giants Aramco and BP smash expectations. But President Biden warns the industry needs to invest more in the US or pay up to DC. Let's take a look at these futures then as we weigh up what's happening in Asia, driven high, as we said in the headlines, by rumours, speculation that maybe a committee is being formed to assess whether or not to roll back some of those COVID restrictions in China come the first quarter of next year. An official out of Beijing has pushed back on those rumours. Nonetheless, the gains are still there. They come off a bit, but you're still seeing some solid upside, particularly when it comes to Chinese companies, tech companies listed in Hong Kong. When it comes to futures, you're pointing to gains of 0.8%. We talk about the focus on the pivot from the Fed. Yes, we've had this conversation before. Yes, we've been here before. But now, arguably, there is something of a consensus forming. You just need to look of the likes of the commentary from the likes of Morgan Stanley, JP Morgan, Goldman Sachs, Standard Chartered, all suggesting that there will be some kind of pivot in the early part of 2023. The language, of course, of Jay Powell and co. Come the Fed decision tomorrow will be central. Let's switch it over, see how things are opening across the major indexes. Here in the UK, we are looking ahead to that quantitative tightening and then the first major central bank to start selling some of those bonds that had built up over that period of quantitative evening. The risks then associated with that, uncharted territory as the BOE heads towards that later this afternoon. The FTSE 100 posting gains of 1%. The CAC current also up by 64 points. Over in Italy, gains of 1% as well. And the Spanish IBEX up by 0.7%, picking up that optimism from Asia. Let's switch it over and see how things are playing out then across asset. And we will drill down on that Asia story just briefly. We'll get more details later in the show as well. Future stateside, after the losses that we saw in the US yesterday, most pronounced on the NASDAQ, down a little over 1%. The S&P E-minis pointing to gains of 0.6%. And the tech story again, and China in focus. Currently at 3,073. You did see gains of around 9% in the session on that index. Coming off a little bit, again, on officials pushing back on that story. Nonetheless, the gains still pretty solid on the mainland as well. Euro-dollar gaining on the back of weakness around the US dollar. That is playing into the risk-on sentiment that we're seeing in the session today. 99 cents there currently on euro-dollar, a gain of 0.5%. 3.99 on the US 10-year. So coming back below 4%, yields off by 6 basis points. We had a hike, by the way, from the RBO over in Australia, but just 25 basis points. And you saw a bit of a rally for Australian bonds on the back of that. Feeding into that pivot conversation, 3.99 on the US 10-year as we look ahead to the Fed on Wednesday. Let's get more now with Bloomberg's MLive managing editor Mark Cudmore. Mark, you've been looking at UK and US yields for us.
Yes, good morning, Tom. FOMC tomorrow, then we got Bank of England. They're both expected to hike 75 basis points this week, but there's a very different narrative about which one can afford to continue being hawkish versus dovish. The expectation is the Bank of England, if they do go 75 basis points, it will be with a dovish narrative. This is a chart of the yield spread between two-year UK yields and 2-year US yields. At the moment, UK yields are about 120 basis points below US yields. This is over the past 6 months, and you can see that's returned to what seems to be the normal range, at least until we got into the leadership contest into the UK and until we got Truss and Kwarteng's fiscal plan, where suddenly UK yields exploded. Then they had to backtrack. Then we removed Truss, and now they're back into that normal range. So this seems to be back to normality or stability. However, if you put this on the 30-year chart, it provides a little bit of a different perspective and shows that actually up until about 2014, 2015, it was much more normal for UK yields to be above US yields for kind of all prior history. And this is really a phenomenon of the last 7 years about that UK yields have been a little bit lower. Now, I'm not sure that this recent era can last. I think we're going to go back into the older era. And part of the reason is that consensus forecasts on Bloomberg say that US inflation next year will be at 4.05%. For the UK, they say it'll be at 6.25%. Now, we all know that all those inflation forecasts get revised all the time, but there's no reason to assume that one is way more accurate than the other. And that gap is 2.2% percentage points, saying that UK inflation will be higher than the US. So why are yields 120 basis points lower in the 2-year term? That means a real yield differential of about 3.4 percentage points. Quite significant. If it stays that wide, that would mean massive downward pressure on cable over the next year. So either we're going to see a lot of sterling weakness against the dollar over the next year, or we're going to see UK yields correct higher relative to US yields. My expectation is we'll see a combination of both. This move higher and cable a little bit softer.
As ever, Mark, really, really interesting context. And as you say, that inflation dynamic and that gap in terms of the forecast between the US and the UK and how that plays out in sterling and gilts, really fascinating. To your point, currently, there's quite a strong move into the front end when it comes to gilts. The 2-year at 319, that's a move lower by 13 basis points. The US 2-year at 443. Bloomberg M-Live Managing Editor Mark Cummock, thank you very much. Now, ahead of the next FOMC meeting, some analysts see a change of pace on the horizon. That is the consensus building. As I mentioned, among JP Morgan, Goldman, Standard Chartered and Morgan Stanley, each see the Fed signaling that the pace of hiking will slow ahead of rates peaking in 2023, so that the economy has a chance to catch up to the hikes which have happened already. Joining us now is Eleanor Taylor-Jollin, UBP co-head of Swiss and Global Equity. Eleanor, good morning. Thank you for joining us. So we start there then with the Fed, of course, ahead of the FOMC decision tomorrow. Do you align with this view, Eleanor, that a pivot is now looking far more likely from the Fed as it weighs up the hikes that have already been pushed through?
I think it'll depend on what data we see coming through. Certainly, the United States does seem to be slightly ahead of Europe in terms of dealing with their inflationary pressures. They were hiking faster earlier. We probably had negative language in terms of hawkish language from the Fed peaking in August. So it would make sense that now we see another 75 basis rate hike and then perhaps slightly smaller incremental hikes going into next year.
Is it too early to start positioning for that scenario? How do you start to allocate around that kind of outcome, Eleanor?
Well, I think our problem as far as the equity markets are concerned is that we have probably reflected the financial price of equity markets, i.e. we've probably got the right price for equity markets at the moment. But bizarrely, and it's actually a contradictory statement, we may not yet have the right earnings number for equity markets. I'm not quite sure that we are fully reflecting yet what may be quite a disappointing year in terms of earnings in 2023. And my fear is that before we start seeing what one would expect, i.e. a multiple expansion in 2023, despite having negative earnings, we may still have the market reacting negatively to those worse earnings than are perhaps reflected in expectations so far. So I think we've still got a little bit of fragility as we go into 2023 and maybe at the beginning of 2023 when companies begin to talk perhaps a little bit more negatively about their expectations for 2023. And then the multiple expansion should start to kick in if the equity market cycle is a traditional equity market cycle.
Okay, Eleanor Taylor-Jolliner, UBP, co-head of Swiss and Global Equity. Thank you for that take, of course, as we weigh up whether or not, indeed, a pivot is now in the cards for the Federal Reserve. Let's bring in Bloomberg's Manus Kranis now. Manus Krani, who is at the ADIPEC Energy Conference in Abu Dhabi, with a very important guest to work through what is happening in these oil markets. Manus.
Tom, you're a good man. I've been called many's a thing in my time. I'll take whatever name you throw at me. I'm delighted to be with yourself and the team. We've got Dan Jurgen here. He's just finished his royal audience with MBZ on the floor of the ADNOC stand. Good to have you. Time is precious. Let's get to the rub of the issues on the day. Biden is talking about a windfall of war. He's flying the kite about the possibility, I suppose, of windfall taxes. You've lived through many administrations. Do you think that this windfall tax can take flight? Is there any real chance of windfall tax?
Well, I think it's a very highly charged political environment right now. Whether you're a Democrat or Republican, you're concerned about high energy prices, what happens during the winter. And obviously the industry is cyclical, and it's now a time when its profits are very strong. But we've seen this before, because then it's a cycle and they go down again. I think what you don't want to do, and what we do need, is people pulling together to address the production issues and to address what happens on December 5th, because you can have a larger crisis in the oil market, and you need people cooperating, not at war with each other.
December the 5th, new sanctions come in. I'm hearing anywhere between 2 million to 3 million barrels, all told, with product and crude, will come off the market from Europe. You talk about a crisis. Translate that crisis into what happens in the market and prices. December the 5th, that oil comes off.
Well, I think the question is, how does Russia respond to it? I mean, you're talking about 1.3 million barrels of crude, and then, as you say, the product, that comes in February, and the product might be even more difficult than the crude, because refining is so tight around the world. But I think you have to ask the question, Vladimir Putin has used gas as a weapon. How would he use oil as a weapon? It may be in his interest to actually constrict supply and see prices go up.
Well, here's the rub, isn't it? The Americans are talking about a price cap between $40 to $60. Do the Russians just shut in and go, nyat? That's the risk, isn't it?
Well, this is, we're in new territory where you're basically putting price controls on one commodity from one country. It's never been done before, and it's the weight of it is going to fall on the shippers and the insurance people to manage it. I think that the administration thinks this will be indicative, and it won't be too different anyway from the discount price. But the question is Vladimir Putin going to allow the U.S. Treasury to set the price of his oil, given everything else? If you read his speech that he did just a week or so ago in Moscow, of all things, he quoted Milton Friedman talking about price controls on tomatoes and how you get a shortage of tomatoes. So, they've had a couple of months to prepare for this.
Do you expect Russia to shut off the taps and completely weaponize oil? Is that an under-talked about risk?
No, I don't think completely, but I think you could see a disruption of some supply. You don't have to take a lot off to create a panic in the market. So you're trying to manage something that's never happened before, and that involves so many different participants.
Let's say there is an escalation. We don't know just how, but you're using the word panic. Panic to me, I'm Bloomberg. I want to know what panic translates to in a price of barrel of oil.
Well, I'm not going to put a price on it, but I do think back, we really haven't had a scramble for oil since the 1970s, and we could have it today. You have, countries are very much at the edge, and I think you have to be conscious of that, and you have to send messages about confidence and not have a kind of conflictual internal message going on.
But we have a conflict between Saudi Arabia and the United States of America. I will talk to Amos Hochstein later on. It's frosty, to say the least. This is energy sovereignty. That's the word you used when you sat in the seat. Translate energy sovereignty, first of all, to the Saudis.
Well, I think this is, it's just interesting how you get a new buzzword, and it basically take the global supply chains, whether it's chips or anything else, countries saying we have to be more self-sufficient. And in oil, too, and natural gas now, it's less reliant on just efficiency in the market, but building security into it and investing in it. And clearly it's a boost for renewable energy as part of that. So I think that what's happened over the last year is really made people rethink about the energy transition, recognize that there has been underinvestment in the conventional resources that you need, and that the transition is happening, but it's not going to happen overnight.
But then finance has been reluctant to invest, hesitant to invest, because of the dislocation in policy from government. There's no clear there's no clear policy, let's say, from, let's say, this current administration, which is no drilling on federal land, then produce more, then talk about windfall taxes. There's a lack of clarity.
You've summarized it very well. It's like step up production now, but we want to stop later.
How would you define the current policy?
Well, I think that this has been a shock for an administration that came in only focused on climate, and it's had to really deal with very severe energy problems that they didn't expect, and they have to work with an industry that they don't really know very well.
Okay, we've run out of time. I didn't get to whether there was folly to cut by 2 million barrels from OPEC at the last meeting.
Well, it wasn't really 2 million, you know,
was it folly or not? Folly or not?
I think that it depends on your perspective.
We didn't get Jürgen on the final call on the 2 million barrels, but it was a paper cut. Everybody's saying that. But the reality is the unintended consequences of a brutal geopolitical war of words between Saudi Arabia and the United States of America. Tom, Anna.
Bloomberg's Manus Granny, of course, on the ground at ADIPAC in Abu Dhabi with that important conversation with Daniel Jürgen on the question of oil and energy going forward. Coming up, the great unwind. The BOE is set to become the first major central bank to sell off assets accumulated during a 13-year-old stimulus program. Gilts currently bid. More on that next. This is Bloomberg.
Has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg Crypto.
Welcome back to the Open. We are 16, almost 17 minutes into the European trading day. Gains being built on yesterday's upside in European markets, at least. The benchmark is up 1.2%. Futures stateside pointed to gains of 0.9% after a solid session in Asia. Let's get back to what's happening in the UK, though, and a big moment for the BOE, which is set to become the first major central bank today to sell off assets accumulated during a 13-year-old stimulus program. The unwind will represent a test case for how quickly markets can shift away from easy money policies. For more, we're joined by Bloomberg's Lizzie Burden. So Lizzie, how significant is this and what is the market reaction likely to be? This is a big moment for the BOE, but also globally for central banks.
Indeed, because this is the Bank of England sailing into uncharted territory for central banks around the world. It's the guinea pig for what happens in markets when you take away easy money. And it really is a big statement from the Bank of England. First of all, to say we are confident in markets, because of course a few weeks ago they were buying bonds to rescue pensioners from the market turmoil that followed the Trussonomics mini budget. But it's also saying we're going to make interest rates the active tool again. We're going to retool in case another crisis comes along in the pipeline. But what we don't know is what the Bank of England is going to do at the long end of the curve, because that's where the market turmoil happened. We're still waiting to hear what they'll do in terms of selling bonds there. And the other thing is that it's not just investors who are watching this today, it's also the Treasury, because of course the BOE is selling at a loss, the Treasury is covering that loss, and it's really a reminder to Jeremy Hunt, the Chancellor, there is a price of fiscal U-turns.
Yeah, interesting. So far, no signs of panic in the gilt markets, money moving into gilts at the front end and the long end as well. Meanwhile, you mentioned the mini budget, and of course that repair work continues between the new Prime Minister Rishi Sunak working with his Chancellor, and they've dropped some hints at maybe tax cuts across the board. What do we know? What are the details? What is coming out of the woodwork?
Yeah, a big exercise in expectations management from the Chancellor and the Prime Minister. We had a readout from their meeting yesterday. It's interesting because this morning there are two reports, damning reports, from the Institute for Public Policy Research and also the Resolution Foundation, saying that government departments cannot take any more austerity because of inflation, and IPPR saying that what they need is £40 billion of tax rises on the wealthiest in society to plug the fiscal black hole. Now, Jeremy Hunt and Rishi Sunak are reported to have said that we do need tax rises across the board, especially on the wealthiest. Those with the broadest shoulders can carry the burden the most easily. And so really they're laying the foundations for a big U-turn from Truss's tax cuts to Sunak's tax rises.
Yeah, a major shift. Lizzie Burden, thank you for breaking that down for us. QT as well in focus, our UK correspondent, of course. Let's bring back Eleanor Taylor-Jolliden, UBP, co-head of Swiss Global Equity. Eleanor, when it comes to the question of quantitative tightening, and of course Lizzie was outlining this for us, a test case really for global central banks, what do you assess is the risk of unintended consequences of this decision by the BOE to go ahead with quantitative tightening in this environment?
I think we're coming back to a situation of normality in the United Kingdom, and we're going back to what was being prepared for prior to that mini budget that we had from Ms. Truss. If we listen to what's being said on the fiscal side, we're clearly getting the message that Mr. Sunak had shared with us during the leadership campaign and during the summer. And we're seeing a central bank doing what central banks do, i.e. setting the monetary policy and making sure that they are setting the monetary policy. Remember, we had some quite interesting language from Ms. Truss about the independence of the Bank of England, which was perhaps something of a concern to some market watchers. And seeing that we're going to move away from the easing towards a tightening was very much what was in the books until the Bank of England had to intervene. So I see this as a return to normality, a return to proper economic behavior, and I would not expect there to be very unexpected consequences from it. Unexpected consequences could come from inflation being more sticky in the United Kingdom than in some other geographies for other reasons.
Where does that leave your appetite then, Eleanor, for UK assets?
Well, my appetite for UK assets is probably closer to the difficulties that we have in trying to balance a high level of inflation in the United Kingdom, a high level of inflation which is slightly behind the curve as far as the United States is concerned. But, you know, the United Kingdom sharing some of the problems that Europe has in terms of high energy prices, some of the problems that the US has in terms of labor shortage, and at the same time trying to change its trading partnerships around the world. And that does mean that there is going to be an adaptation which has to happen within the UK economy, which I think I'd prefer to observe from afar rather than get too involved in.
Okay, not wanting to get too involved in UK assets as we kind of adjust to this new reality then. Eleanor Taylor-Jollidan, UBP, co-head of Swiss and Global Equity, thank you. Talking of UK assets, you're currently seeing the FTSE 100 gaining round 1.4%. The pound is up and gilts are bid as well. Yields down across the curve. Coming up, our exclusive interview with Credit Suisse chairman Axel Lehmann, who says the bank is not for sale and will thrive again. That interview is next. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Welcome back to the Open. 25 minutes into the European trading day. Pretty solid gains across the benchmark of a little over 1%. Futures in the US also higher by between 0.8% and a full 1% for the Nasdaq futures. Here in the UK, the FTSE 100 trading at 7,184. That's a gain of 1.3% as we look ahead to the quantitative tightening of the Bank of England later today. Of course, investors continue to weigh up what we expect out of the Federal Reserve tomorrow. The language from Jay Powell and whether he signals that the front loading is coming to an end, whether or not he aligns with the views that we've heard from Morgan Stanley, JP Morgan, Goldman Sachs, that a pivot could be on hand in the first quarter or the early stages of 2023. It is risk on today. The dollar is down and bonds are bid. Let's check in on some of the individual names as well. Important corporate stories, and of course the politics overlaps when it comes to oil and BP. A very solid set of numbers. You're seeing losses of 0.8% on the stock, but you're looking at third quarter net adjusted income profits, I should say, of $8.1 billion US. The estimates had been for a little over $6.1 billion. And BP also announcing a $2.5 billion share buyback. Rio gaining on the back of just an upside across commodities in terms of copper and iron ore. DSM is down by 2.8%. Stay with us. An exclusive interview with Credit Suisse's chairman. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open. We are 30 minutes into the European trading day, and here are your top stories. Seeing a dovish turn, stocks and treasuries rally on optimism that aggressive rate hikes by the Fed are nearing an end. Chinese markets surge on speculation the country may exit stringent COVID restrictions. The long, unwinding road. Yes, the Bank of England becomes the first major central bank to start quantitative tightening. Downing Street, though, says higher taxes are on the way. And bumper energy profits, oil giants Aramco and BP smash expectations. But President Biden warns the industry needs to invest more in the US or pay more to DC. So it is a risk-on environment that we're seeing this Tuesday morning as we look ahead to the Federal Reserve. On Wednesday, of course, the signaling from Jay Powell will be crucial. And that consensus view now, almost consensus view, and you're hearing that from the likes of Morgan Stanley, JP Morgan, Goldman Sachs, Standard Chartered, that you will get the end of front-loading, that the pivot is coming sooner rather than later. And that is being digested by these markets. They have the Fed then on Wednesday, the BOE, of course, quantitative tightening later this afternoon, but of course that rate hike and the expectations that maybe you get 75 basis points from the BOE on Thursday, though warnings from others that maybe that would be a little bit too much to digest. Across the benchmark, you're seeing gains of over 1% then here in Europe, building on the green that we saw yesterday. The DAX is up 137 points, and here in the UK, the FTSE 100 higher by 98 points. Pretty decent gains of 1.4%. A lot of that is down to what's happening in basic resources. Let's switch it over and have a look at those sectors then. The boost as well from what's happening in China, the rumours, the speculation, it is just that at this stage, but nonetheless, rocket fuel for Chinese stocks, particularly those listed in Hong Kong, ending the session up between 4 and 5% when it comes to Hong Kong stocks. And in terms of those tech stocks, I should say, mainland shares as well, also solidly in the green on the back of that. Basic resources up 2.8%, consumer products gaining by 2.5%, and the bottom list, food and telecoms. The riskier parts of these markets in terms of what's happening across basic resources, and the safe havens currently near the bottom end, but still gaining around 0.4%. Let's get to an important conversation then we've had with the chairman of Credit Suisse, of course, that embattled Swiss lender. Well, he says he's convinced that the bank's newly unveiled restructuring plan will allow it to come out stronger. Axel Lehmann told us exclusively that the Swiss lender will thrive again and is not for sale.
I think we figured out where we need to go, and we took some bold and really very important decisions for the group, and it's now really about, looking forward and to execute that plan.
So safe to say, do you think that the worst is behind you? And do you think that eventually things are still kind of in the works and that you might actually have to raise more capital? Is that still in the plan? or is that even part of the plan?
No, look, we announced the capital increase. What I said, that is fully underwritten. We will do that, and now it's really about execution. Step by step, quarter by quarter, we will come out, what do we do with securitized product? We will refine our plan for Credit Suisse First Boston. We will show progress on the operational transformation, on the cost reduction program. I think we came a long way as a group. We really came a long way. I think we have taken the right decision. We are really looking to some of the fundamental issues that we have. We go back to a little bit the core of the business, the core of the origins of the company. So we really remind ourselves our key strengths, and that's what we are going to execute. So I'm all excited. I'm all excited.
Credit Suisse's Axel Lehmann speaking there. The stock currently up a little over 3%. Let's talk energy now, starting with Aramco and BP earnings. It's been another bumper quarter for big oil. Both saw massive profit beats. There were second highest quarterly results on record. And earlier this morning, we heard from OMV CEO Alfred Stern about the outlook for this energy market.
There is some curtailment of production, right? In some of the chemical industry is under big pressure. Any industry that uses a high portion of energy has a lot of challenges at this moment, and I think we'll see some pressure on this in the next quarters.
OMV CEO Alfred Stern speaking there to Bloomberg's Manus Krani at the ADIPEC Energy Conference in Abu Dhabi earlier this morning. Let's switch focus to China, because the action in Chinese stocks has been quite remarkable this morning. They roared back today, and the yuan strengthened on unconfirmed social media posts speculating that a committee was being formed to assess scenarios on how to exit COVID-0. To discuss this, I'm pleased to bring in Bloomberg's managing editor for Asia stocks, Lian Ting. Lian Ting, walk us through what's happening there. A huge rally that we saw in Chinese stocks. Do people really believe that this is going to happen soon, that this committee is going to be formed, and that this is really being assessed now by top officials in Beijing?
Yeah, I think it depends on who you're asking this question to. If you were to ask local consumers, things are actually getting worse since the Party Congress. If you look at the ramped up lockdowns, big cities in China, including Shanghai, Guangzhou, and Zhengzhou, we're all seeing various levels of lockdowns. But if you were to ask forward-looking investors, they are actually, some of them, I should say, are positioning for a reopening indeed. Allianz Bernstein last week told us they're actually positioning their portfolio for reopening. They're picking up airlines and reopening stocks. And JP Morgan's Kolonovich last week also said investors should buy the dips into Chinese stocks for reasons including reopening hopes. So I think there is a bit of a diverging views among local consumers and investors.
Very, very interesting. Yeah, foreign investors then positioning for a reopening. We haven't had confirmation that it's going to happen yet. But you touched on this, but just outline in a little more detail which sectors of the economy would be best positioned to kind of benefit should that reopening happen.
Yeah, we actually asked analysts and investors this question, and they're telling us, including Bloomberg Intelligence, in the U.S., so sectors including big tech, consumer sector, and energy, they are the best positioned to capitalize on a reopening for Chinese economy. In the U.S., in Europe, I should say, we're looking at the luxury sector, resources, and semiconductor. So in general, I think tourism-related sectors are obviously big winners because Chinese tourists actually accounted for about 20% of international tourism spending in the year before the pandemic.
And you talked, I'm going to loop back to your comments and your analysis there on what we're seeing from foreign investors. What are you seeing from domestic Chinese investors then? Are they not matching that enthusiasm that we're seeing from the likes of Allianz, for example?
Yeah, I think for domestic investors, they're a bit jaded because they're living in China, they're living in communities where lockdowns keep happening. So for them to have the kind of enthusiasm that reopening will actually happen soon is a bit difficult. I think they are actually saying, this is a tactical trading opportunity. This is pure rumor. I think a lot of them have told us. Whether they actually think a government is at the senior level talking about the kind of committee and the kind of system to be put in place for a reopening, I don't think they're telling us that as of yet.
Okay, Bloomberg's managing editor for Asia Stocks, Lian Ting Tu. Thank you. On a pretty significant day for Chinese equities. We'll see how long it lasts and whether it can carry on until tomorrow. Across the benchmark, the CSI 300 gained about 3.6%, ended up 3.6%. And over in Hong Kong, the tech index, the HS Tech, ended up 7.8%. Right, coming up, Brazil and Lula winning, but Bolsonaro has not yet conceded. More on Brazil's election and that uncertainty next. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg.
Welcome back to the Open. 41 minutes into your European trading day. It is risk-on gains of 1.2% across the European benchmark and futures in the US pointing higher as well. Let's get the Bloomberg First Word News now with Leanne Gerrans. Leanne.
Good morning, Tom. President Joe Biden says he will seek to impose higher taxes on oil companies that are making windfall profits without reinvesting in production. Ahead of next week's midterm elections, Biden called on big oil to put consumers' profits before anything else. Democrats have tried unsuccessfully to levy a windfall tax for over a decade. Now, Ukraine has warned of widespread blackouts after a massive wave of Russian missile attacks damaged power and water supplies on Monday, including in the capital, Kyiv. The Kremlin, meanwhile, says grain shipments would be much riskier and more dangerous after it pulled out of a Black Sea agreement, blaming an attack on its Navy vessels in the region. Australia's central bank has raised rates by 1/4 percentage point and signalled further tightening to come. The RBA lifted the cash rate to 2.85%, its highest since 2013, in a move which underlines its pivot away from outsized increases investors. The central bank also cut its outlook for economic growth, and higher rates are starting to bite. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Tom.
Leanne, thank you very much indeed. Let's get back to what's happening in Brazil then. Brazilian President Jair Bolsonaro is still keeping silent after his defeat in Sunday's runoff election, leaving voters guessing on whether he will actually concede. Joining us to discuss this is Bloomberg Opinion's Clara Ferreira Marquez. Clara, what is the latest that you're hearing then from Brazil? He hasn't conceded yet. Is it going to happen imminently? What is going on?
So absolutely, at the moment we have silence from Bolsonaro himself. Though it's really important over the last sort of 24 hours we have seen a number of figures in his camp, his vice president, figures within the military really indicating that they will move towards concession. Bolsonaro, however, is really stuck between two poles. He has his core of supporters who really do not want him to concede and are conducting protests across Brazil, mostly on highways. And then, of course, his allies who really do want him to move on. On the other hand, the other thing that we're seeing is really Lula rushing to build this very broad coalition that he will have to construct in order, of course, to govern Brazil.
And we're seeing protests as well, of course, on the ground in Brazil, pro-Bolsonaro protests. What happens if he doesn't admit defeat?
I think it's very unlikely, because his allies have really pushed him to do so. He will have to at some point. At the moment, silence is, as they say in Portuguese, silence is consent. The problem, of course, is the longer he stays silent, the harder the transition is. And of course, the longer he stays silent, the longer he can keep his base going and really fueling these protests that we're seeing, really sporadic, but still quite significant across the country.
Okay, interesting on the silence aspect of it. When it comes to Lula and his progress in kind of building out a cabinet, naming key economic officials, has there been any movement on that front? Do we know anything more about the Lula team?
Not yet. We're still waiting to hear, especially on the key appointments, the finance minister. We do know that he's going to build a very large cabinet, very broad one, probably with 10 more positions than the Bolsonaro government had. He really has a lot of people that he needs to bring on board, which obviously creates problems of its own. But without it, he really won't have the support in Congress that he needs. And that will be crucial to pushing through some of the very deep and necessary structural reforms that lie ahead, especially going into a difficult 2023 where government revenues will be lower.
Okay, Bloomberg Opinion's Clara Ferreira Marquez, thank you for that analysis on the latest out of Brazil. Meanwhile, Israelis head to the polls today for the country's fifth election in under 4 years, giving the UK a run for the money on the political chaos. But analysts aren't convinced this vote can break the cycle of political deadlock that has doomed previous governments. Joining us now is Elisa Odenheimer, who is Bloomberg's editor in Israel. Elisa, what are the key issues then this time around?
Well, the key issue really seems to be whether or not former Prime Minister Benjamin Netanyahu should return to lead this country. It's basically evenly split between the pro-Netanyahu forces and the anti-Netanyahu forces.
Okay, so it's a question as to whether or not Netanyahu is going to be back to the fore. What are the polls telling us about the likelihood at this point? How much support does Netanyahu have?
Well, it's really too close to call at this point. I mean, according to the opinion polls, Netanyahu's Likud party is, according to the opinion polls, going to get the largest number of seats. But in order to lead the country, he'll have to put together a coalition of at least 61 seats of the 120 member parliament. And according to opinion polls, he does squeak through in some of the polls, but in some of the polls, he just doesn't have enough. On the other hand, his main rival is the current caretaker Prime Minister Yair Lapid, and according to the opinion polls, he has not been able to get enough seats to to form a coalition either. So we really don't know if there's going to be a sixth election possibly.
Wow. Wow. Okay.
Yeah.
Remarkable. What are the key differences when it comes to economic policy of both of these candidates?
You know, there's not a really large difference in economic policy between the two blocs. The main difference really is personal, whether people think that Netanyahu should lead the country or not. In terms of economic policy, it's really hard to pin down any big differences between the two.
Okay, really interesting. Thank you. Alyssa Odenheimer, Bloomberg's editor in Israel, on that fifth election, possibly a sixth, certainly a fifth, and what it means, whether Netanyahu will be back in the seat of power there in Israel. Continues to watch developments there. Coming up, central banks are in action this week. We're going to break down the market expectations. Of course, the Fed tomorrow, the BOE on Thursday. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Markets expect another rate hike.
Investors obviously skittish.
What the Fed do on November 2nd is key to everything.
But where will the Fed go from there?
No sign it is ready to stop tightening.
Everybody talking about a step down.
They're going to wimp out and they're going to blink. Trust Bloomberg for the fastest coverage and exclusive analysis.
Do we want this Fed to force a recession?
The Fed's going to torpedo momentum.
In markets like this, everyone's a long-term investor.
Bloomberg Surveillance. The Fed decides. Tomorrow on Bloomberg, your global business authority.
I think we figured out where we need to go, and we took some bold and really very important decisions for the group. And it's now really about, looking forward and to execute that plan.
So safe to say, do you think that the worst is behind you? And do you think that eventually things are still kind of in the works and that you might actually have to raise more capital? Is that still in the plan? Or is that even part of the plan?
No, look, we announced the capital increase. What I said, that is fully underwritten. We will do that, and now it's really about execution. Step by step, quarter by quarter, we will come out, what do we do with securitized product? We will refine our plan for Credit Suisse First Boston. We will show progress on the operational transformation, on the cost reduction program. I think we came a long way as a group. We really came a long way. I think we have taken the right decision. We are really looking to some of the fundamental issues that we have. We go back to a little bit the core of the business, the core of the origins of the company. So we really remind ourselves our key strengths, and that's what we are going to execute. So I'm all excited. I'm all excited.
Okay, Credit Suisse's Axel Lehmann speaking to Yvonne Mann there exclusively in Hong Kong. That stock currently up 2%. It is, of course, a major week for central banks ahead of the next Fed meeting. Banks are seeing a slowing in the pace of rate hikes. That is the consensus that's starting to build now among major US lenders, which see the Fed signaling a slowdown in the pace of hiking ahead of rates peaking in 2023. That is so that the economy has a chance to catch up with the hikes that have already been pushed through by the Fed. Joining us now is Joe Easton, our equities reporter. Joe, let's start then with that consensus that's starting to build. Whether it's Morgan Stanley, JP Morgan, Goldman, they're all starting to see a pivot from the Fed. What is your assessment? 75 basis points is what markets are pricing in tomorrow, but it's the guidance that's so central.
That's right, and I think the guidance potentially has a bit of a hawkish risk to it, because I think that given the way that banks have brought down their expectations slightly, there is a risk that Powell could fuel a rally in bond markets, also in stocks a bit as well. So I think he's got to be careful to not fuel that expectation too much, and therefore he might actually lean towards being a bit more hawkish and actually saying, well, yes, the rate path might slow slightly, but we're still going to get to the same base rate eventually, so don't get too excited. So I think some traders may be caught on the wrong side where they're pricing in too much dovishness, and I think that there is a bit of a hawkish risk going into that decision tomorrow.
Maybe pricing in too much dovishness. When it comes to the BOE, a market's pricing in too much hawkishness. Their decision on Thursday.
Well, that's it. The BOE has been a bit of a crazy month, obviously, given the budget and the climb down on the budget that we saw. That's really blown up the expectations. So consensus is at around 75 basis points, but some people are now saying 50 basis points. Some people are still at 100 basis points, and there were some banks during the height of the mini-budget crisis saying there could be a 200 basis point hike. So those expectations for the BOE really been blown out the water now. And I think that we do need to see some actual change in data, and also, most importantly, the report from the OBR. That's now not coming until the November 17th budget announcement. Getting these projections on the government finances, it was supposed to have come yesterday. That would have made the BOE easier to predict. But given we haven't got that, I think there's a lot of risk going into that one.
A lot of risk, yeah. Clearly, they would have preferred to have that OBR assessment, wouldn't they, before that decision on Thursday. When it comes to the earnings story, BP standing out for us today, of course, maybe additional political pressure on that company. What is standing out to you from the earnings season so far?
So I think generally it's been slightly weaker than expected, but if you bring in banks, other financials and the energy companies like BP, then it's slightly better than expected. So I think we've seen, obviously, BP today with that $2.5 billion share buyback. We had TP ICAP, the big broker. They've a booming broking trade, booming interest rate market. So those companies are doing well. But I think what we need to see is how the cost of living crisis and the interest rates are hurting demand. We haven't quite seen that in most companies yet, and I think that will probably come next quarter or maybe the quarter after. But at the moment, we're seeing the initial signs of that, and therefore, taking out the banks, taking out the oil, earnings are actually slightly weaker than expected.
Joe Easton, equities reporter, thank you very much for breaking down some of those key themes. The markets here in Europe gaining 1.3%. It is risk on still. Futures stateside pointing to gains of between 0.8% on the S&P E-minis. The Nasdaq futures higher by now a full 1 percentage point. Bonds also bid. Yields are lower, whether it's US Treasuries or gilts here in the UK ahead of quantitative tightening. Stay with us. Surveillance Early Edition is up next. This is Bloomberg.
I started, I had no idea it was going to turn into this little tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Actively sell off assets bought during a 13-year stimulus program. And Credit Suisse tells bargain hunters not to bother. Chairman Axel Lehmann tells Bloomberg the Swiss bank is not for sale. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta and Kaylee Lyons in New York. Matt Miller is off today. And Kaylee, a lot to talk about this morning for a day that seemed quieter than the rest, perhaps, given we are ahead of the FOMC, Bank of England jobs report. But some really interesting market-moving rumours only, but the market jumping on them through the China session.
Yeah, unverified social media post is circulating talking about China potentially forming a committee to talk about strategies to exit COVID-0. Again, unverified, I would stress that, and yet it spurred a major rally in brisk assets. Really stocks higher across the board, and it was technology that really led the charge. The Hang Seng Tech Index up nearly 8 percentage points overnight, so a massive move there, while the Chinese benchmark, the CSI 300, was higher by about 3.5%. So obviously a lot of optimism about the potential reopening, or at least an unleashing of some parts of the Chinese economy that has been under this COVID-0 policy for years now, and it gave a lift to the Chinese yuan as well, strengthening against the U.S. dollar by about 0.6%. Offshore yuan dollar trading at 729.27 at the moment. Now, other than that unverified social media post, the other news out of the Asia-Pacific region overnight that's worth mentioning came in Australia. The RBA hiking rates by just 25 basis points. And yes, they signaled more hikes are to come, but still that is such a small size hike compared to the outsized hikes we've gotten used to, and especially the hikes we're expecting from the Federal Reserve and the BOE in the next 2 days. So on the back of that, you saw the 3-year yield in Australia down about 3.5 basis points to just shy of the 326 level. But again, Creedy, 25 basis points, not what we're expecting tomorrow, not what we're expecting on Thursday.
Not at all. In fact, I'm curious about how much that brings to the question of what is and what isn't actually priced into the market today. Perhaps a little bit more optimism when it comes not just to the stock market, but to the bond market as well. Excuse me. Take a look at futures up about 0.7%. The bond market also, like I said, catching a bid. The 10-year yield, though, slightly below that key 4% level, 398 on the 10-year yield. But look, already that volatility really sinking in, down about 6 basis points on that note. But take a look at one of the currency pairs that I'm really watching. It's not the dollar. It's actually the Brazilian real versus the Mexican peso. This is crucial as a kind of emerging markets cross to go to. When you're looking at exposure, you're looking at two countries in the EM space. It's Brazil, it's Mexico, and there tends to be a seesaw, a kind of trade-off between the two. Given the lack of commentary from Bolsonaro against the win from Lula, you are seeing a little bit of weakness in the Brazilian real, but once again, only down by 0.1% against the Mexican peso. So we will see as we get more developments out of the country, whether or not that actually sustains or perhaps worsens. The other part of the equation you have to know is simply the grain story around the world. Commodities really kind of rising here, and that's why I'm looking at the Bloomberg Commodity Index, Anna, up about 0.4%.
Yes, and some of those commodities rising, as you say, around that grain story and what we heard from Russia over the past 48 hours or so, Critty, and some of those commodities rising because of that narrative that developed through the China session, and it might turn out to be nothing, but it was certainly a rumor that the market decided to buy. So we saw, as Kaylee was pointing out to us, we saw strength coming through in Chinese stocks, in Hong Kong tech stocks, and all of that filtering through into higher energy prices, oil prices on the rise, and filtering through into basic resource stocks doing pretty well here in Europe. So the European picture looks pretty positive. The CAC 40, the FTSE 100 all up by more than 1.5%. Let's have a look at some of the components of this and some of the interesting movers of the day. Basic resource stocks, as I mentioned, are getting a boost from that China story, up by more than 3%. BP, on the other hand, it started out actually pretty well, but that early gain fading as they report near record profits, and they announce another big share buyback. That seems to be a couple of the trends that we've seen from other big oil businesses, big energy businesses. Prosus, this is a Dutch listed business that has a big stake in Tencent over in China, and so this is feeding really directly through from that Chinese story, up by 7.9% on the Prosus share price in response to what we've seen overnight in Asia. And Credit Suisse up by 2.1%. This, as the chairman says, that the business is not for sale. Of course, it could still attract interest, Kaylee, whether he wants it to be for sale or not, but certainly they don't see any need to put the business up for sale right now.
Yeah, and we're going to have more on that Credit Suisse story in just a couple of minutes. First, though, we want to touch on what we got from the Biden administration yesterday. President Biden saying he will seek to impose higher taxes on oil companies that are making windfall profits without reinvesting in production, a promise that will be all but impossible to deliver. His proposal came as gasoline prices are still high a week before midterm elections. He spoke yesterday.
You know, at a time of war, any company receiving historic windfall profits like this has a responsibility to act beyond their narrow self-interest of its executives and shareholders. I think they have a responsibility to act in the interest of their consumers, their community, and their country. To invest in America by increasing production and refining capacity.
Meanwhile, big oil earnings are continuing to roll in, with Saudi Aramco and BP both reporting surging profits. And as Anna mentioned, Creedy, BP announcing another $2.5 billion worth of share buybacks. And this is the catch-22 for these big oil companies. On the one hand, you are raking it in because prices are high. You want to give that back to shareholders. And yet that's facing some very real criticism and potential repercussions on the part of lawmakers, both here in the U.S. and frankly as well, where Anna is in the U.K. and in Europe.
You know, and I think that is a crucial part of the story, which, on the other hand, you're still seeing pushback coming from the administration. We just heard from President Biden. I think what's important to point out, Anna, though, and big credit to Javier Blas over at Bloomberg Opinion, talking about this, is that the last time some kind of windfall tax was really imposed, it was back in the 80s when we had a similar inflation story. And even back then, it ended up hitting production numbers more than it actually ended up really recouping some of those profits for the government. So I think that's an interesting trade-off to see. Do we see that repeat?
Yeah, well, we certainly see some of those windfall taxes in place in various European countries already. The UK example does have some carve-outs for those businesses that want to invest in UK energy. So interesting to see how that develops stateside. Back here in the UK, the Bank of England is set today to become the first major central bank to sell off assets accumulated during a 13-year stimulus program. This is active quantitative easing now. The unwind will represent a test case for how quickly markets can shift away from easy money policies. Joining us now for more is Bloomberg Markets editor Valerie Teitel. Valerie, take us through the significance of this move then.
Yes, the Bank of England is hosting its first auction today as it continues to roll off this balance sheet at an active pace. It's going to be nearly $10 billion a quarter. What we know is that there's going to be $6 billion of sales into year end. It's going to comprise over 6 different auctions, all $750 million each. But look, this is a big unknown for the market. This is the first central bank to really take on active sales. And we've even had words from the Debt Management Office chief saying that this will likely increase gilt market volatility. Now, we know that the Bank of England, when they decided to raise rates last month, it was unanimous to begin this balance sheet unwind. And let's hope, you know, maybe we'll hear more from them on Thursday on this balance sheet unwind, whether they're still confident that the $6 billion pace that they've announced to year end will be there.
Valerie, let's go from the Bank of England to the Federal Reserve right here stateside. Chairman Powell made a really interesting comment back in March about his favorite kind of metric he looked at for inversion. I think you have a chart for us. Walk us through it.
Yeah, that's right, Critty. Here is Jerome Powell's preferred yield curve. It is the 18-month forward 3-month T-bill minus the current 3-month T-bill yield. And as you can see, this curve has really gotten close to hitting inversion. Now, why do we care about these kind of things? Well, we know that Powell and the Fed are likely to give us a hint that they want to step down their size of rate hikes. But what things will they point to justify that the step down is needed? Will they point to things like this, like the preferred curve inverting? Will perhaps they talk about last week's softening wage inflation data in the ECI print on Friday? Or will maybe they talk about the housing market? It's going to be a fine needle for the Fed to thread by signaling a slowdown without pushing the market to jump to conclusions that it means a lower terminal rate. And we know that a hawkish surprise from the Fed could come in the fact that they signal a step down, yet they mention that the terminal rate is a bit higher than they expected at last meeting.
Okay, yeah, it's going to be a really interesting one to watch then, isn't it? The extent to which they risk moving financial conditions in a way they don't want to. Valerie, thanks so much. Bloomberg's Valerie Scheitel with the central banking stories that matter this morning. Now back to corporate news. Credit Suisse chairman Axel Lehmann says the lender is not open to takeover discussions after unveiling the company's long-awaited turnaround plan. He spoke with Bloomberg's Yvonne Mann in an exclusive interview this week.
We are going to, to strive again. So we don't have any takeover discussions, and at that point we truly believe we want to stay independent.
Bloomberg's Charlie Wells joins us on set here in London for analysis. Charlie, very good to see you this morning. So how seriously does the bank need to consider talk of takeover bids? I mean, why are we getting this kind of messaging?
Right, so he is talking to us about it, right? So they shouldn't not take it seriously. But of course, a lot of the reporting that Bloomberg has done on this has pinned a lot of this talk back to unfounded rumors from blogs in Switzerland. So, seriously, but not too seriously. But when you look at the situation, it is precarious, right? This bank is cheap when you look at its share price, but it's also selling things that people want. We know that buyers are lining up to buy its Securitized Products Group. We know that Saudi National has invested 9.9%. So it's a little bit like going into a suit store trying to buy maybe one tie, and then, a buyer starts to think, maybe I should buy the whole suit. But of course, we have the chairman saying, not for sale.
Well, Charlie, you mentioned the share price, and frankly, it is a painful chart to look at. What does Credit Suisse need to do to turn that around and really just this broader narrative?
Ooh, Kaylee, that is a really painful share price to look at, down 57% on the day of that turnaround discussion on Thursday. And it really needs to work, but they don't have a lot of room to maneuver here. Now, one move that has attracted some attention has been the share price buying $1 million worth of the bank's shares. So that could potentially instill confidence. But previous executives at the bank have made similar moves, so there's no guarantee that that will work. It really is about this turnaround plan. There were questions about whether it was enough, and it certainly needs to be.
All right, Bloomberg's Charlie Wells, thank you so much. Now, we talked about how it's painful when you look at the Credit Suisse chart. It is less painful looking at some other charts in pre-market trading, at least on an intraday basis here in the U.S. We already were discussing the rally we saw in Asia overnight, the big moves to the upside for technology stocks, those Chinese technology stocks in particular in the Asian session, and their ADRs listed here in the U.S. are also doing fairly well by extension. The likes of Alibaba, JD.com, Baidu, each up in the ballpark of 6 to almost 7%. And of course, that reopening story benefits other companies as well, including casino operators, the likes of Las Vegas Sands and Wynn Resorts, which have major revenue exposure to Macau. The easier movement of people, more people potentially going on holidays to the gambling enclave to pay some bets, may help these companies a lot. So as a result, Las Vegas Sands up about 4.5%, Wynn Resorts also up about 3% before the bell, Anna.
Yeah, really interesting to see. Not a lot of facts behind any of this reporting, is there, around what is or is not going on with the COVID policy in China, but certainly the market's jumping on that story, Kaylee. Let us tell you what's coming up in the program. Diana Omoa joins us, Kirkoswald's CIO for Long Bias Strategies. We'll talk to Diana about expectations for global growth, given what we're hearing around China, also expectations around the Fed, of course. And we'll be live at the ADIPEC Energy Conference. That is taking place in Abu Dhabi, of course. Bob Dudley joins us, former BP CEO and current chair of the Oil and Gas Climate Initiative. Plus, how a form of climate bookkeeping has allowed companies to exaggerate their progress when it comes to taming pollution. Read more of today's Big Take story online or on the Bloomberg terminal, and listen to our new Big Take podcast on iHeartRadio or the Bloomberg Business app. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Hello, I'm Emma Barnett, and I'm a journalist and presenter. This is my new show, Emma Barnett Meets. First, I'll be meeting Chinese artist and dissident Ai Weiwei, and I'll talk to the novelist and political scientist Elif Shafak. Tune in to watch those who shape our world explain how the world shapes us. This is Emma Barnett Meets on Bloomberg Quicktake.
The markets expect another rate hike.
Investors obviously skittish.
Will the Fed do on November 2nd is key to everything.
But where will the Fed go from there?
No sign it is ready to stop tightening.
Everybody talking about a step down.
They're going to wimp out and they're going to blink. Trust Bloomberg for the fastest coverage and exclusive analysis.
Do we want this Fed to force a recession?
The Fed's going to torpedo momentum.
In markets like this, everyone's a long-term investor.
Bloomberg Surveillance. The Fed decides. Tomorrow on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off. And check out the chart that he's missing here because it's equities bouncing back from their lows as you start to see the terminal rate kind of stall at 5%. Now, we know Goldman Sachs over the weekend came out and said, well, you know, we actually also think that the upper bound of the terminal rate will peak around 5% as well. Of course, they are late to that call. The market had already decided that, pricing in that peak was going to come in March of 2023. As you have that narrative come on, the stock market actually bouncing back and saying, well, maybe that the pain is over. But I have to ask our guest here, Simon White, Bloomberg macro strategist, joins us about whether or not this is actually going to stick. Simon, the consensus on Wall Street seems to have been that there's going to be a pivot in terms of what's driving the U.S. stock market. Is it still going to be this macro narrative, the Federal Reserve at the helm, or do you start to see a little bit more attention paid to earnings? What do you think?
Well, I think that both are going to be important. The earnings thing is, we've had a mixed season so far, but the earnings outlook. I was looking at this yesterday. To misquote Oscar Wilde, to get one bad earnings chart is misfortune, two is worrisome, and many more than that is alarming. And every kind of indicator I see says that earnings are going to continue to get worse. Now, the only thing holding up returns right now in the S&P is revenues. The only thing contributing positively. Margins, PE multiples, are contributing negatively. So revenues in a sort of slowing economy should continue to slow as well. So it's really hard to see from a fundamental perspective what really is going to keep equities in sort of any sort of positive shape.
And Simon, how does that filter through then? If that's what you're seeing, so margins and PE, you're telling a kind of negative earnings story, but the revenues have been holding up. How does that filter into stock market reaction? Because to Kriti's point, we've seen one of the big drivers being Fed expectations, of course. And if we start to see some kind of pivot or step down in the Fed policy at a time when the earnings story gets worse, does stocks go up or down from there?
Well, it's tricky, right? So I think we're at peak Fed hawkishness. We're very close to, or a peak, by the way. I think there'll be another peak later on, right? But I think we're at current peak inflation. So we're at a peak in Fed hawkishness, a peak in global central bank hawkishness. But guess what? Like, if you look back historically, when the Fed stops hiking, so the end of a Fed hiking cycle, the stock market essentially goes nowhere for 6 months before the rally comes. So even if we do hit peak Fed hawkishness, this is not a sign you're going to get this immediate kind of upturn and rally in stocks that people might be expecting.
Simon, obviously the Fed decision is tomorrow. Assuming we get a confirmation of the step down, the market hears what it expects to. Could it be disrupted by the jobs report 2 days later, the midterm elections a week from today, CPI 2 days after that? I mean, are those going to be catalytic events if the market is just assuming still peacochishness?
Yeah, I think so. I mean, I think that the inflation narrative is very much tied into the midterms. So I think for me, yes, obviously the jobs numbers will be important if it's a big outlier, but I would say the following week is kind of more important if we, with the midterms, and we get the CPI number a couple of days later, if the CPI maybe comes in lower than expected, and kind of the political environment perhaps is gradually begin to change after that. There's not so much pressure on the cost of living crisis. You know, then I could conceivably see that we really are in a situation where the Fed can feel it can step down from its kind of slightly more alarmist inflation rhetoric, and we move to a more growth focused format.
So maybe we've seen peak hawkishness, and then you point to a period maybe of a plateau, or at least that's what history tells us has happened. Where does that leave tech stocks? Because tech, of course, has been very responsive to that hawkishness from the Fed.
I think tech is going to really struggle. I mean, again, if you look at tech has a very strong relationship with global markets with China. So if you look at, for instance, money growth in China leads tech earnings very strongly, and of course China right now is in its own situation. It's still got the COVID lockdowns. It's a capital outflow. So that combination of global headwinds and China headwinds is really going to make it struggle for tech, and therefore if tech can't leak, it's very difficult for the market to make new highs.
Okay, yeah, interesting. A sector geographical link we don't often make, so thank you, Simon, for bringing that to our attention. At Bloomberg, Simon White with the latest on the markets this morning, and you can get market analysis. Check out MLIV Go. That's the function to use on the Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
Difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
To the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays, this is Bloomberg. November 8th. 8th, as Americans decide the future of Congress and state legislatures. Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune in to Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Caitlin Lyons with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. Russia is warning that the security of ships sailing Ukraine's grain export corridor cannot be guaranteed. That comes after Moscow halted its involvement in a grain agreement. Russia has repeated unsubstantiated claims that Ukraine has used the corridor for military purposes. In the UK, Rishi Sunak's government says it's inevitable that all Britons will have to pay more taxes to restore stability to the public finances, especially the richest. Sunak met with Chancellor of the Exchequer Jeremy Hunt on Monday to discuss the budget. According to the readout from the Treasury, they agreed that tough decisions are needed on tax hikes and spending cuts. In Brazil, protests by supporters of President Jair Bolsonaro have intensified. Bolsonaro has remained silent over his loss in Sunday's election, refusing to concede defeat to Luiz Inácio Lula da Silva. Truckers backing Bolsonaro blocked the main highway linking Sao Paulo and Rio de Janeiro. They said they don't agree with the results of the voting. And under new owner Elon Musk, Twitter is limiting content enforcement work just before U.S. congressional elections. The social network has frozen some employee access to internal tools used for content moderation and other policy enforcement. That's curbing the staff's ability to clamp down on misinformation, and it raises a question, Kriti, of regulatory scrutiny over platforms like Twitter, because we have seen a lot of noise made on Capitol Hill about content moderation, about the spread of misinformation online, and so close to an election, that seems very, very testy.
You know, it feels almost like a case of deja vu to some extent, Anna, especially when we saw this kind of play out in 2020 with Facebook. I'd argue with Twitter, with Instagram, with WhatsApp as well, but I remember Mark Zuckerberg really coming under the wire for how much they were doing in terms of content moderation.
Yeah, and ahead of the midterms, as Kaylee points out, that certainly is going to be something that is watched very closely as Elon Musk takes over Twitter. Also, what is watched is the business model, of course, and whether he does start to charge for those blue ticks, whether $20 is the right price. He was tweeting back against, he was tweeting this overnight, essentially, when people were pushing back against the idea of $20. He was tweeting overnight saying, well, I've got to make the business work somehow. How about $8? So it seems as if there's plenty of room to influence that number if anybody feels they want to. Right, coming up live on this program, we will be back at the ADIPEC Energy Conference in Abu Dhabi. Bob Dudley will join us, former BP CEO and current chair of the Oil and Gas Climate Initiative. Really interesting conversation to be had there. We'll also speak later to Diana Amoa with a look at the markets ahead of the Fed. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A warning for big oil. President Biden says he'll ask Congress to pass a windfall profits tax. Meanwhile, BP joins the energy firms posting near-record earnings. An historic move for the Bank of England. It becomes the first major central bank to actively sell off assets bought during a 13-year stimulus program. And Credit Suisse tells bargain hunters not to bother. Chairman Axel Lehmann tells Bloomberg the Swiss bank is not for sale. I'm Anna Edwards in London with Kaylee Lyons and Kriti Gupta in New York. Matt Miller is off today. And plenty of top stories to talk about then, Kriti, when it comes to big thematic pieces. But in terms of what's been driving markets over the past 24 hours, rightly or wrongly, expectations changing around China and COVID policy. And that seems to have put some fire under European stocks, Asian stocks, and perhaps US futures.
Yeah, I would agree with that. And you know what's interesting, though, is that in the 2 days before a Federal Reserve meeting, the market tends to sell off. Now you're actually seeing a bid into the market. I think that's a really crucial difference going around this time when you look at what's actually being priced into the market. That 5% terminal rate, market consensus now, also Wall Street consensus, I should say. Take a look at futures, though, up about 0.7%. I would argue Anna's point is 100% correct. What you're hearing from China could actually be the game changer for the U.S. equity market, as could be the game changer for the bond market as well. 3.97 on the 10-year yield. The volatility is what's crucial for me, though, because ahead of the Federal Reserve, you would think that a 75 basis point hike is priced in. You would see some stability there, yet it's only a couple of hours into the U.S. trading session, at least in pre-market. You're already seeing it bid by about 7 basis points lower on the 10-year yield. But that's not the only volatility you're seeing. You're also seeing it in the currency market, not necessarily in the dollar, but you're seeing it in the Brazilian real. I love to look at this currency pair, the Brazilian real versus the Mexican peso, kind of the EM currency pair to go to in the Western Hemisphere. Given the elections we saw over in Brazil, the quietness coming from Bolsonaro specifically, how much exposure do people really want to Brazilian assets right now? I think that's why you're seeing a little bit of weakness there, down about 0.1% against the Mexican peso. And with that story, the commodity story follows, because it's not just what's happening in South America, it's also what's happening in Ukraine, perhaps, and even in China. A lot of that creating a little bit of a bid into the agricultural market and the oil market as well, both lifting the Bloomberg Commodity Index to tune about 0.2%, Kaylee.
Yeah, Kriti, I keep thinking about the rally we've seen in so many commodities this year because supply is so tight and demand had rebounded, and that was without China, with China maintaining COVID zero policy. So what happens if China does indeed reopen? That is definitely a question for the commodity market, and it's a question for a lot of companies as well that have exposure to China and the region surrounding it, like Macau, for example. That is what is the driving force behind the rally in Las Vegas Sands this morning in pre-market trading. It's up about 4.5%, considering Macau is a very important market, and the potential easing of COVID zero policy may make things better in the gambling enclave. And of course, you also saw a big rally overnight in Chinese technology stocks. The ADRs are doing the same in pre-market trading. Alibaba is up nearly 6%. percentage points, but it's really more a broader tech story. Of course, the move led by Asia, but the likes of Tesla as well are moving higher. It's up about 1.75%. And then I just added Uber to my board as well this morning, Anna. It's up about 3%. It will be reporting before the bell. Yes, earnings season is still ongoing, so watch out for those results in a couple of hours.
Yeah. Absolutely, we shouldn't forget earnings season, as you say, still ongoing, Kaylee. And all this China talk, of course, is just still rumor in the Chinese market, but it was a rumor that the Chinese equity markets decided to buy, and that is filtering through into other markets globally, and certainly here to Europe. The stocks Europe 600 up by 1.2%. The basic resources sector up by 3.25%, as we see some commodity prices being lifted by talk about what if we saw some loosening of Chinese COVID policy. BP is down by 0.3%. The company reporting near record profits, also doing a big buyback, but with some of that in the price then this morning. And Credit Suisse up by 1.9% as they continue to try to stage some kind of recovery from all the scandals of the past, the restructuring we saw announced last week, the sell-off in the share price in the immediate aftermath, and again, the shares trying to rebuild then, Kaylee, some ground.
All right, Anna. Well, let's go now to the ADIPEC Energy Conference in Abu Dhabi. Manus Craney is there now with Bob Dudley, the former CEO of BP, who is now the chair of the Oil and Gas Climate Initiative. Manus, over to you.
Kenny, thank you very much for that introduction. He doesn't really need an introduction. It is Bob Dudley. Bob, good to have you with us today. You have managed through many cycles, many presidents, many administrations. We've now got a new kite flying from the House of Biden, perhaps a windfall tax. Do you think it will take hold, or is it just a puff piece ahead of the midterms?
Well, I don't know. It's clearly a political rhetoric aiming at November 8th with the midterm elections. It's very harsh rhetoric for an oil and gas industry who's probably producing flat out, both in oil fields and in refineries. Taking that money and that capital, I think the CEO of Exxon reminded it goes back to American people in the form of dividends, which go into massive amounts of pension funds. But the rhetoric is quite divisive and unhelpful, I think.
And it does trickle down, it's trickle-down economics, one could say, into the dividend in your 401k. But big oil will use that narrative, oh, windfall tax, we won't invest, we'll delay our capex. How true is that? You've run BP, you've run TNK BP. How constrained can capex really be on the back of maybe a one-off or a twice-off windfall tax, really, Bob?
Well, it depends on what kind of a windfall profits tax. There was one in the United States in the early 80s that went on for years, and it did curtail investment. And you could see that again. I mean, companies have a capital budget based on their earnings and supply of cash flow. So, of course, they'll right-size the amount that goes into capital versus dividends versus big investments, in capital. So it will reduce it somewhat. And this is at a time when the oil and gas companies are really turning into energy companies. They're investing in renewables and all kinds of other things, which have a lower rate of return right now than oil and gas. So that's probably the one that might suffer, which seems counter to what we're trying to do in the energy transition.
Well, let's talk about that, because the Oil and Gas and Climate Initiative, which is your world, the debate is this. You have windfall tax delivered by the government, which may stymie capex. But the backwash of that is into your world, which is about those investments in the transition. Is that the tail risk of this windfall tax? Is that the risk that you worry about?
I think it's a reduced amount of investments in everything with the windfall. It doesn't matter, even oil and gas projects, but the renewable projects, the clean energy tech, everything will come down. And I don't know, it's not going to eliminate it, most certainly, but the percentage available will likely drop. These companies are really committed to the energy transitions. They see it as their future. They're investing in wind, solar, even some in nuclear.
We were walking out of the Mansions yesterday and we were chatting about today, and you said, man, there's some really easy wins in your world of the transition. What is the easiest win that we should be talking a little bit more about?
Well, I think, to me, it's not only investing in renewables and the technologies that produce energy, but clearly one of the issues on emissions is methane or methane. And that, to me, is the low-hanging fruit. The technology is coming along with satellites, aircraft, drones, sensors on the ground. There's going to be nowhere to hide. And so the industry's coming together, sharing data, and we'll all be able to look at it like weather maps in the future here. So this is going to be the first big thing to do to reduce emissions.
Okay, well, let's keep an eye on that. I want to reflect back. You also hung your hat on TNK BP. That was the days where you got to know the Russians really well. Here we go towards December the 5th. The real risk is this: Russian oil flowing into Europe gets halted. Talk to me through the prism of the Russian psyche. I'm quoting my inner Tom Keane here. Talk to me through the psyche of the Russians. Will they just weaponize oil and not allow the Treasury to dictate the price of oil from America and these sanctions? How will it bite? How will the Russians react to the two issues?
So I was at TNK for about 6 years, and then I've been on the Russian national oil company Rosneft until the invasion happened.
Yes.
Stepped away from that. So I do feel like I know them. I know how they think. I think the West does not recognize that they really didn't want NATO on their borders. And so I think that's part of the psyche. One of the Russians said to me one time, "How would you feel, Bob, if the Russian troops were on the Alberta border?" So this is quite an emotional issue with it. I would never have expected this invasion. Few people I know that understand Russia would have expected it either. But now, I learned something a long time ago. If you poke a Russian in the chest, they will punch you in the face. And I think just this last week, the supposed drone attacks on the Black Sea Fleet in Crimea resulted in this really strong reaction here. And so I don't know where this is going. I hope rationally, there's a way out for everybody. I think there needs to be a face-saving way out for everybody here, or it could get worse.
Who knows where the de-escalation ramp is in this? We need to close off with China. Again, the other topic that we briefly touched on. How big a boost to price of oil do you think we can get if China incrementally opens and then reopens more fully in the back half of 2023?
Well, China's grown for 8 to 10% for 2 decades now.
Yeah.
Pandemic comes along, the world, everything, second largest economy in the world, shuts off. And then price of oil drops terribly down to negative. If you remember, there was a day there it was negative. And then coming out of the COVID, suddenly the engine of China came up again and the price of oil went up. I think that was a primary thing, as well as lack of investment in the industry due to ESG reasons and the pandemic just put a lot of pressure to not invest in oil and gas projects. It's affected it. So today, China growth rates, which I thought might be 5 or 6% this year, looks like they could be under 3. That's a historically very low level. So we're all watching to see whether the COVID lockdowns come out of it, what Chairman Xi decides on the economy. They're going to need lots of oil and gas, but it may not be at the 8% growth rates we've seen before. And I think that's a huge variable in where the price of oil can go.
Okay, Bob, thank you very much. We're going to hand it back to London to your other favorite on Bloomberg, Anna Edwards. I think I'm handing back to Anna. How are you?
I'm fine, thanks, Manus. I'm sure we're all his favourites. Manus Crowley with Bob Dudley, former CEO of BP. Really fascinating conversation. He, of course, now chairs the Oil and Gas Climate Initiative. Really interesting to get his perspective, though, after years in the oil sector. More from Adipec Energy and the conference taking place there later today. Manus will be speaking to Amos Hochstein, who is US Special Presidential Coordinator for Global Infrastructure and Energy Security. That's at 6 a.m. in New York, 10 a.m. here in London. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Uber CEO Dara Khosrowshahi. That's at 5 p.m. in New York, 9 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lyons and Kriti Gupta in New York. Matt Miller is off today. Let's talk about Twitter. Elon Musk's Twitter shakeup continues, with Musk expected to appoint new product leadership. This comes after Musk met with over the weekend with close friends and advisors on how best to change the service that he bought for $44 billion. Joining us now to discuss is Bloomberg's Alex Webb. And Alex, he's certainly wasted no time in changing the people at the top. What do we expect to see on that particular front?
Well, we don't quite know who he's going to appoint. He's brought in a few advisors, the likes of Jason Calacanis, the VC, as well as someone from Andreessen Horowitz, the big venture capital firm. There have been whispers that the former product head has been around the building, unsure if they're going to appoint him. The thing that our colleagues, Kurt Wagner, Ed Ludlow, and Sarah Fry are reporting is that product team heads have been told to identify 50% of their headcount to lose their jobs, which clearly that is unsettling if you are one of those people. Is not quite the 75% of the total the Washington Post had reported had been identified 2 weeks ago, but it's still a hefty number.
Alex, another change that he's potentially talking about is charging users for things like blue checks. So it's kind of a selfish question as someone with a blue check who doesn't necessarily want to pay $20 a month for it. Is that going to work? I understand trying to diversify your revenue sources from just solely advertising sales, but do we have an understanding of what the reception of those kind of ideas is like? Are people willing to pay to use Twitter?
I think there are two parts to this. There are the existing people who have a blue check, whether they be willing to continue to pay for it. I've seen estimates that there are in the order of 300,000 blue ticks out there. If you extrapolate and $20 a month, you're looking at maybe $6 million a month in additional revenue, maybe then $72 million a year. That's not going to move the needle. It's more about attracting other people and sort of encouraging others who don't currently have a blue tick to pay for the privilege, and that will be when it starts to become a little bit meaningful. I think, for the likes of us, he probably would hope that Bloomberg, in our case, would pay for us to have a blue tick. It seems I don't know what Bloomberg would do, but I think a lot of other media companies might go, well, we'll pay for our official account at New York Times or at NY Times, for instance, to have that. We're not necessarily going to pay for the 2,000 people in the rest of the newsroom.
Alex, what kind of precedent is there here when it comes to the social media ahead of the midterm elections? I mean, we talked about how Elon Musk will, of course, come under some scrutiny, but I believe 2 years ago, Mark Zuckerberg came under quite a bit of scrutiny for Facebook and its role in the 2020 election. What kind of precedent are we looking at?
Well, we don't quite know what Twitter is doing with its, content moderation. There have been whispers that fewer people are being given access to those tools. You could view that actually as a positive because perhaps too many people had access. It's pretty close to the midterms, clearly, so it's hard to know whether at this stage any changes would be able to have any meaningful impact. It's more worrying if you look a little bit further forward to the presidential election. Facebook obviously has been in the crosshairs of this for some time. It obviously has far more users than Twitter does, in the order of 2 billion active users, whereas Twitter has about 10% of that. Facebook has been criticized for 6-8 years on this front, and in the 2020 cycle, there was still plenty that it could do. So lots of people inferring that if you're tamping back on some of those efforts, the results aren't likely to be positive.
Yeah, some interesting political scrutiny, no doubt, on many angles here. I saw that one Democrat was urging a security review because of Saudi Arabia's involvement as a backer of this Twitter deal that Elon Musk has put together, of course. Alex, thank you very much. Bloomberg's Alex Webb joining us with the latest on Twitter. Coming up on the programme, we'll get back to the broader markets ahead of the Fed. Diana Ramoa joins us, Kirkoswald CIO for Long Bias Strategies. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer Wednesday on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now let's take a look at what is ahead today, and Matt is missing. The Bank of England will become the first major central bank to actively sell sovereign bonds held on its balance sheet. In Israel, voters are going to the polls for the 5th time since 2019. Expected U.S. economic data includes manufacturing PMI and job openings. And finally, earnings continue to roll out. Pfizer, Uber, and AMD are among the companies reporting results today, Anna.
Yeah, so we're still in earnings season. As investors await more earnings, eco data and central bank decisions, let's talk to our guest this hour, Diana Ramoa, CIO for Long Bias Strategies at Kirkoswald. Very nice to have you with us, Diana. So you're focused on long strategies, long dated strategies, but let's focus on the here and now around the Fed, and obviously that'll have implications. What kind of pivot or step down, or describe it however you like, are you expecting to see from the Fed? Because, and how likely are they to signal that, because there are financial conditions, risks attached?
So I think in terms of this current hiking cycle, this is probably the most important meeting for the Fed, because it's not just about them signaling where they want rates to be, it's also about them signaling the magnitude of hikes going forward. Markets are already pricing in a much slower rate of hikes from the next meeting onwards. And I think the Fed is really in a conundrum right now, because they've said they're data dependent, and they really will let the data dictate how far they go. So forget about whether it's 75 or 50 going forward. And so far what we're seeing from the data doesn't actually indicate that they need to be pivoting aggressively. And I think that's where the nuance in this conversation around whether the Fed is pivoting or just going back to 50 basis points, maybe possibly 25 basis points down the road becomes important. We've seen this narrative play out in other economies, particularly in emerging markets, which the US inflation right now is behaving like an emerging market economy from an inflation perspective. You pivot too soon, or if you step down too soon and second round effects are starting to de-anchor, then you run the risk of actually losing your credibility as a central bank.
Yeah, interesting comparison. Chrissy.
Yeah, Diana, I wanted to ask you specifically about the Fed's thinking here, because what seems to be baked into market consensus and arguably perhaps Fed thinking as well is that inflation has already peaked. But then if you start to factor in potentially a windfall tax here in the States or simply the grain agreement that Russia has decided not to abide by, still having a lot of those shipments, it's something that's boosting the commodity sector today in the trading day. How much of that is the market perhaps missing when it comes to what the Fed is going to do next?
I think the market right now is trading on a backdrop that we're not in anymore. They're trading on a backdrop where they expect the Fed to support financial conditions, but ultimately, and that's a strong point you're raising, a lot of the inflationary pressures we're seeing are also supply driven. And to the extent that food, energy prices are not in the Fed's hand to control, to the extent that some of these pressures are coming from geopolitical shocks that have nothing to do with monetary policy, it's going to be very hard for the Fed to step down credibly. And when you look at the data, core inflation is still rising. We haven't seen a peak to that. Unemployment rate is still at the lows, so we're not seeing any sort of easing in the labor market. And, you know, to your point, food and energy prices are still an issue that the Fed has to contend with.
So Diana, finally, as you are head of long bias strategies, is there any long duration asset you feel safe buying right now?
The question is, why would you buy long duration assets when cash is actually yielding what it is right now? If I can get cash at 4% plus, do I want to take that extra risk of duration assets, especially when we're just starting to see quantitative tightening coming into play? We have the Bank of England today will start selling bonds. The Fed is still underway with its QT program, which doesn't really necessarily bode well for duration in the medium term. And so I'd say for me, cash is probably where I'd be more biased to position, if anything, not necessarily going for duration just yet.
Okay, and what would change that view then, Diana? What do we wait for cash to become less attractive?
We need to see the data turning. Everyone is trading recession, but we're only seeing a recession in parts of the world. In the curve that matters, in the US curve, the data still remains very strong. So you need to actually really be expecting to see a recession coming in or an anticipation that inflation has peaked. We're just not seeing that in the data.
Okay, so we don't see it in the data yet. Very good to talk to you. Thank you so much for making your way in to see us. Diana Amoah joining us there from Kirkoswald. And as Valerie was pointing out to us earlier, we are seeing further inversion, different parts of the curve now inverting, perhaps the parts of the curve that the Fed likes to talk about. We'll see whether that has any impact on Fed thinking. A really interesting conversation, though, setting us up for the Fed meeting, which kicks off today, concludes tomorrow. We get the results of it tomorrow, of course. That is it for Early Edition. Surveillance is ahead with Tom, John and Lisa. They will be hearing from Julian and Emmanuel of Evercore ISI, amongst many others. They'll keep the focus on the markets for you. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
People are talking more bearish than they're actually investing.
Inflation will prevail above Fed goal. I don't think that far above goal.
For our base case, we still think that the Fed might end somewhat below 5% policy rates.
They don't want to break anything. What the Fed always wants is to see what have their actions done.
The central banks have been wrong before.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
How was Halloween?
Halloween was good. I won as a swap line and survived.
Well, welcome back. I'm surprised they didn't throw eggs at you.
Well, they did.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures just about positive, up 0.9% on the S&P 500. Have you been war profiteering?
I've been don't get me going.
What is that about? I'm getting you going right now.
We've seen all this before. My father drove a VW diesel. Way you go. OPEC 1. OPEC 2, let's go after big oil. Nothing's changed in 50 years.
That was a rant. That wasn't even a concrete policy proposal. What was that yesterday from the president?
It wasn't microeconomics, it wasn't macroeconomics, and it wasn't oil economics. And I think a huge body of people that support the president and do not support the president have common ground here.
And Bramo, I'm not sure many people in this market took it too seriously.
Nobody took it seriously. A windfall profit tax, talking about that with less than 2 weeks to go for the election. Basically, can't do anything about it. People saying, well, he had to come out with something after the biggest profits ever for the likes of Exxon. The question is, does it have any influence whatsoever if it's toothless, if it's basically just simply a stump speech? Right. And that's what we're going to be analyzing.
Ed Morris 2 days ago before the rant, quote, going long crude this winter looks risky. Morris has been dead on about oil under $100 a barrel. He says he's still with that. I'm not going to go into the details, but the answer is, how do you get to 100? How do you get to 125? Can you imagine the rhetoric at 125?
Can we get to the good news out of Europe? They're forecasting mild weather for the month of November.
Yeah.
That's some good news out of Europe. So storage capacity was at a decent level coming into winter. The weather's turned out to be a little bit milder than expected. So this winter, okay. But Lisa, I think it does nothing to address next year. So this energy crisis at the moment is going nowhere fast.
Especially because if you cannot build the stores, and this really is the key, right? If you cannot build the stores, what's going to help you do that if Nord Stream is not online? And if you don't necessarily have the stockpile in the U.S. of the Strategic Petroleum Reserve, to go back to that point, at what point do we refill to create a buffer?
Weather matters, John. This coming Saturday, according to Google, this is in Fahrenheit, John. I'm sorry I didn't have time to go to see. Munich, low of 36 degrees on Saturday. Is that what this debate's about, or is it about the businesses of Germany And
well,
their
we thought
use
we'd
of
have
oil.
rolling blackouts at this point.
Right.
We thought we'd have industries shutting down across Europe, and we've escaped that reality.
Yeah.
I don't think you can escape the fact that Europe is turning lower. We still go back to the PMIs we had last week, Lisa, which were in the 40s. So let's not pretend Europe's out of a tricky situation. It's just not the worst case situation we feared maybe a couple of months ago.
And if you dug underneath the CPI report yesterday out of the Eurozone, it was not just energy underpinning some of those gains. And I think that that is also not lost on people. That yes, that 10.7% headline number, people said it was stunning, right? Wow. And it was this idea that perhaps this is being fueled by energy, but it's not, because underlying that is a 6.9% or something like that, was stripped out of energy core inflation.
Do you think this is the new normal? Red headlines on the weather on the Bloomberg terminal. Is that the new normal? I don't. We have to get used to forecasts on the weather.
There's a war going on, and one of the summary articles I saw, John, here on the war is blackouts in Kyiv, water shortages in Kyiv, etc. There's a war going on, so you get those kind of banners.
Equities right now up 0.8% on the S&P to kick off the month of November. Can't believe it's November. Honestly, absolutely ridiculous how quickly this year has gone, Tom, particularly the back half. October, just a massive month of gains in the month of October.
Making it up. And, I know you don't follow the Dow, but the Dow there with all sorts of data back to in October that is a record move, second highest since the 1930s, whatever. And remember the gloom that we saw in August and September about equities coming off the June rally. Down we go. And it's not a June, I would suggest it's not a June equivalent, John. I just watched the VIX to start the date at 25.83. We're a long way from that 30 level.
Major squeeze. Yields in a lot, down 9 basis points on a 10-year, 395.30. And in the FX market, euro dollar slightly positive.
Why is that?
Up 0.5%, 99.27. The weather, TK, the weather. The weather's better.
I think the weather's better, but also
Stronger
I think
euro.
there's some growth gloom out there.
You think we're raising some of that a little bit on the margin?
Away from the Fed, I think there's some growth gloom.
Curve flatter, Bramo, curve flatter.
I can't give a narrative to any of these daily moves. I'm not even going to try sometimes, unless it's really obvious, because right now it feels like we're just sort of dancing on the head of a pin with respect to where we are headed and when sort of we reach the bottom or some sort of capitulation. Today, the earnings do continue. This week, we are going to get almost a third of all of the earnings of the companies in the S&P 500 today. Uber comes before market. Very curious about the ride-hailing service and $20 salads that are delivered to you through them. Airbnb aftermarket, curious about travel. How much can that really hold in, given some of the crimp that you're seeing on people's household budgets? Also, we get from Pfizer, Simon Property Group, SoFi Technologies. How much are they extending some of that consumer lending, that consumer leverage right now ahead of a downturn? Devon Energy and Mondelez International. So a real nice swath of the economic outlook, particularly with respect to the consumer. We do get the Bank of England today becoming the first major central bank to actively sell some of its holdings on its balance sheet with 750 million pounds, excuse me, of short-dated gilts. How much does this really affect a market that's gotten whipsawed? I was shocked that gilts are one of the best performing asset classes of October, gaining 3.9% after all of the turmoil because of some of the policy response by the Bank of England and because of what happened on the political sphere, but the gilts are still down 24% year to date. So, it's a win some, lose some. And tonight at 10 a.m., we get a slew of U.S. economic data, including the ISM manufacturing for the month of October. The granular data underpinning that is going to be interesting. Do we see any potential easing in some of the supply chain constrictions that you've been seeing? And we're also getting the JOLTS job openings, Tom, you were saying about. But really, it's going to be interesting from both the labor market and the manufacturing. How much do we see some sort of softening or at least easing in the tensions to give the Fed a little bit of a breath of relief?
And folks, I was sort of like PMI, so what? And Pharaoh taught me to watch these numbers. John, what is it? Basically 49.9 is not 50?
Anything south of 50 contraction.
It's like a big deal.
Above 50 expansion. PMIs right now in Europe in the 40s, in China in the 40s. We, of course, look to the ISM here in America. We'll look to that a little bit later. Did you see JP Morgan last month? I was breaking down the numbers with my producer, Jamie, this morning. Up 21% in the month of October. What a rally.
The most important interview of the day, folks, Julian Emmanuel is going to be on with us here in a bit with Eric Friedman, and I'm sorry, everybody's getting it wrong again, and they're performing, and the big quality companies led the way, as symbolized by JP Morgan and Anaconda Copper in the Dow Jones Industrial Average.
I'm letting that go. I'm getting straight to Eric Friedman, Chief Investment Officer at US Bank Asset Management. Eric, what did you make of that monster move we've just seen in October? Some people say it feels like July. Fade it. What do you say?
Jonathan, we're more in the faded camp. We do think that the just where volatility is right now, it's certainly implied that you can have those sorts of moves. Clearly, it was a huge move, obviously, in Tom's favor at the Dow, the best month since '76, and so. Look, we think that there's this natural desire right now to own stocks, that people want to say, hey, look, the bottom may be in. We still think that there's some pain in front of us. And so we think this is really more of a good time to reposition one's portfolio. It's been a little offsides. Good time to rebalance back. But again, we think this is a move to fade, not to buy into.
What do revenues do? I mean, how do you quiet, stodgy money, Eric? How do you handle 9.5% revenues as Julian Emanuel models it at Evercore? That number is going to migrate in. How do you manage that with quality stocks?
I think that's where you have to start, Tom, is on quality. And again, there have been plenty of times when we've emphasized that there are times to be more small cap, mid cap, more long duration growth, if you will. Now's not one of those times. So we do think that old economy is going to work. We think that if you have to be involved, which again, you should have some exposure, of course, to equities. There's plenty of reasons to be excited about areas like utilities, as well as oil. The energy space, we think, is probably one of the higher conviction ideas that we have. And so emphasizing those sorts of names we think makes sense. So again, the key thing for us, Tom, is we're thinking about maybe rotating back into tech will be when rates start to come back. And there's no guarantee we'll be back to the 2020 playbook, which was, duration comes in and tech works. We still think there's probably a little bit of evidence we have to see through earnings that CapEx is still there. We're not quite at that conclusion, but again, old economy, utilities, energy infrastructure, great places to be right now.
If you like the energy companies, do you care or do you pay attention to what President Biden said last night about windfall profit taxes?
We do, Lisa. I mean, there's almost been this Pavlovian response from the energy complex over the last, 15, 20 years, which is oil prices go up, you send out rigs, you go out and find, and then too much supply hits, and watch, rinse, repeat. You see the cycle continue. Now, for all the reasons you did a great job covering this yesterday, Lisa, if you look at what ESG, if you look at activist shareholders, there's been such restraint by E&P companies to go out and find. We still think that, again, this tax, if it's viewed as a true tax on return on invested capital, there's not going to be the allowance from shareholders to let companies go out and find and start projects. So we do think that this is probably going to have the reverse impact that the White House may want, which is White House wants to lower prices. If this is meant to, again, provide another piece of evidence for activist shareholders to restrain E&P companies, this probably sends prices higher, not lower.
Eric, thank you. Eric Friedman there of US Bank Asset Management. Bramo, this president on the campaign trail, I think it was in late 2019, said, I'm going to end fossil fuels. Just contributes to cultivating this environment whereby these fossil fuel companies are doing exactly what they're doing.
Yeah, well, and this comes to this idea where you have politicians that want to see a transition to a green future at a time where physically that's not yet possible in the way that they want to see. The transition's taking longer than they thought that it would, so they've got to deal with the now, and the now is a very fossil fuels now.
Do you remember when the former president wanted to rebuild the SPR, Tom, when crude prices were rock bottom, and the Democrats said that it was tantamount to a bailout for big oil? We got it taken out of the bill.
We got to be careful here into the election season, but what I will say is we can state where's the economic foundations of some of these statements, particularly on taxation. I don't hear economists saying this is gospel. I hear politicians saying this is gospel.
We talked about it a number of months ago. Is this central planning? If this is not fair, can you tell us what percentage of our profits is fair? Do you have a number?
The gentleman from West Virginia, I believe he's a Democrat this week, would suggest yes, what you just stated is true.
Equity futures up 0.9% from New York.
Manchin.
This is Bloomberg.
Did I do enough Dow in that block? I think we need more.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers are expected to raise interest rates another 75 basis points at the end of a two-day meeting that begins today. It's the Fed's most aggressive tightening campaign in 4 decades. Still, some strategists believe that this stage of rate hikes is at an end, and the Fed will begin smaller increases next month. In the UK, Rishi Sunak's government says it's inevitable that all Britons will have to pay more taxes to restore stability to the public finances, especially the richest.
Sunak met with Chancellor of the Exchequer Jeremy Hunt on Monday to discuss the budget. Now, according to the readout from the Treasury, they agreed that tough decisions are needed on tax hikes and spending cuts. North Korea is threatening the U.S. with what it calls powerful measures if the American military doesn't end exercises with South Korea and others. The rhetoric may be an effort by Kim Jong-un to lay down the groundwork for his first nuclear test in 5 years. Now, this week, the U.S. and South Korea started joint air drills after exercises on land, sea, and air in recent weeks. Under new owner Elon Musk, Twitter is limiting content enforcement work just before U.S. congressional elections. The social network has frozen some employee access to internal tools used for content moderation and other policy enforcement. That's affecting the stamp's ability to clamp down on misinformation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Increasing our investments in America or giving American consumers a break. Their excess profits are going back to their shareholders and they're buying back their stocks, so the executive pays are going to skyrocket. Give me a break. Enough is enough. If they don't, they're going to pay a higher tax on their excess profits and face other restrictions.
The President of the United States going after big oil yesterday evening. From New York City this morning, good morning. Equity futures up by about 8 or 9% on the S&P 500. Picking up on that story, we can head over to our good friend Manus Cranny. Morning, Manus.
John, thank you very much. Yeah, joining me now is Amos Hochstein, the Special Presidential Coordinator. Amos, good to see you in Abu Dhabi. We were just playing some of the presidents on there talking about continuing buybacks and dividends would perhaps bring the wrath of the White House upon them in terms of taxes. But to his speech last night, let's talk about last night. The president warned, I'm paraphrasing, that there's a risk of a windfall tax if you don't reinvest. Is this just political kite flying ahead of midterms? Is there any real possibility of windfall taxes?
Well, Matt, first of all, it's great to be here with you in Abu Dhabi and on Bloomberg. It's always great. Look, the president this has been a consistent message from the president, from the administration, asking companies to take their profits and invest them back in America, back in production and refining. We have been experiencing elevated prices as a result of geopolitical dynamics, not because of markets, but because we have a war, a devastating war in Europe, where the perpetrator of the war is one of the largest oil producers in the world, one of the largest gas exporters in the world, and is using energy as a weapon. This has seen a massive increase in prices, while of course we still have a huge economic growth from post-COVID that is also creating demand growth. So we're telling companies, make a profit, pay your shareholders. But there's a level and a limit to how much profit you can take without investing.
You weren't saying that to oil companies when oil was at $20 in the United States of America. I think the point that
$20 is when naturally companies don't invest. $100, $90 is naturally, historically, when companies do invest. The problem now is that they're not doing what they always used to do.
I'm not here to represent big oil, Amos. I'm here merely to put the proposition, which is, people have said to me, you look at this administration's guidance to big oil. Day one, Keystone was binned. We have now the discussion about a new taxation format, and we have a host of sort of no drilling on federal land. We have various messages which are respectfully schizophrenic. How can you plan for 5 years, 10 years CapEx, Amos, with schizophrenic policy changes like this? This is how it's been described to me. What's your response to that?
I don't think it's been schizophrenic. I think we've been very clear to craft. Look, we have to deal with the short term, medium term, and long term. We're in a time when we have to increase production because we need to make sure, to ensure global economic growth,
yes,
we have to have reasonably priced, affordable energy resources, oil and gas. To meet our goals of where we want the world to go by 2035 and 2050, we have to accelerate our investments in renewable energy. Those are consistent with each other. They're not competing with each other. So investing right now, here's a certainty we're giving oil companies. We've said that we are going, now that we have released 180 million barrels of oil onto the market from the SPR, for our national security interest, we need to buy it back. We need to buy another 200 million barrels back over the next several years. We have said, the president himself has told companies, I will tell you what price I will buy it back at $70 or so. I will start buying back at large amounts. So I will provide you with certainty of price to some degree, so to answer the questions you've asked.
Well, there's one way to push a market against you, and that's to tell them at what price you want to replenish the SPR. But I know it's a lengthy document, and I know it has detail. We move on, which is about the price cap from the United States of America. I think the language is an effective and a strong level. $40 to $60 is what I understand, the numbers that's in the Bloomberg stories. Do you really believe $60 is going to keep Russian oil flowing onto the market? Because the conversation I've had with everybody here, everybody's worried about the sanctions coming to bear here at home in Europe. Does $60 keep Russia oil flowing in your mind?
So outside of a Bloomberg article, which I would never want to argue with Bloomberg.
I think it was Treasury Secretary Yellen who indicated it was $40 to $60.
No, I don't think so. We are going to set the price when we do that, and we'll announce it. I think all these numbers out there that are just rumors and leaks that I can tell you are not substantiated by reality, and people should just ignore those. I really would hope people would ignore those numbers. We've always said that our goal was to keep the Russian barrels on the market while we restrict the revenues to Russia at a point when they're using those revenues to finance the war. There's a balance here. We have to figure that out. There's a difference in the balance between when we were at $120 a barrel versus when we were at $76 a barrel. So we are going to have to figure out, and we're doing that now, of what the right price is going to be in order to make sure that Russia is still incentivized to sell on the market while we make sure that they're not over-profiting beyond that level.
Will it be materially higher than 60?
I can't tell you what the price is, because if I say anything now, they're gonna have rumors again on that. But look, we get it. We understand how the market works, and we want to make sure that our goals are achieved.
Just clarify, I deal in fact, not rumor. And with that in mind, I want to understand the potency of the price cap when it comes, because I caught up with the Indian oil minister yesterday. It's very unlikely, the speculation is, it's very unlikely India and China, two of the biggest customers out there for Russian oil, will sign up. We don't know, but given the price cap, it's a fairly impotent proposition if two of the biggest customers of Russia won't sign up.
I disagree, because the country, what we're telling people, you don't have to sign up. It's not, a membership. As long as you are purchasing Russian oil at a lower price, that's what we want to achieve. You have a market price of Brent. Everybody negotiates. You know that nobody buys strictly Brent. There's all kinds of negotiations. Do you really believe that India and China are not going to be negotiating and are not already? We know that Russian oil is not selling at Brent right now.
No, it's selling at
a discount. So it's just about how much of a discount.
Okay, well, let's see what you produce. You're here in ADIPEC. How would you describe Saudi-US relations at the moment? Are they broken? Are they fractured? What is the word that describes it at the moment?
Well, I think people attach too much to the drama of things and the soap opera of things. Saudi Arabia and the United States have had an 80-year relationship. We've had some ups, we've had some downs. We usually come back from the up. We have a broad range of interests, from security to economic. We had a significant disagreement that I don't shy away from that. We had a disagreement about the OPEC decision. We think it was a mistake to announce a cut of 2 million barrels. But we continue to talk to them, and we're going to continue to have a relationship that serves our interests. We're just going to have to evaluate how that best works in all ways.
The last time you were in the region, you left here. Did you leave here? Did you leave Saudi Arabia with a conviction and a solid belief that you were going to get more oil on the market from the Saudis? Were you misguided? Did you walk away with that belief? Clarify for us today.
So one of the things that I never do is talk about what we talk about, my conversations with government officials.
I understand that.
Scenes. So I will say that the good thing about my conversation with folks, I'm always very straightforward, and I appreciate that they can be with me. They knew that we believe that a cut right now in this environment, under these conditions, was not good for the global economy. It was not good for their consumers. It's not good for our economy and consumers. We thought it was a mistake. I think the point that we have to make...
So then the Biden trip to Saudi Arabia was about oil all along?
No, it was never about oil. Think about the things that we've done. Look, we are the United States. Our interests are varied and deep. And look at what we achieved on that trip that I think was really important. There were overflights from Israel, security arrangements, security integration, security and economic integration of Iraq vis-a-vis Iran, extending the ceasefire with Yemen. I mean, these are really important things. We announced all kinds of other achievements while on that trip that have nothing to do with oil. At the same time, when we announced the trip, we also saw after the trip an increase in production in July, an increase in production in August, an increase in production in September.
But come on.
Saudi in August had its highest production levels.
Amos, respectfully, it was a shock, and it provoked immediate press releases in the news conference I was in Vienna that night. The question the market wants to know is how serious is the White House about a retaliation? Is retaliation the right word? What are you going to do? Is it going to be arms sales? Is it going to be NOPEC? Is it going to be, let's say, more additional SPR releases? What is this retaliation that's been so much made of in the media?
So again, I have to deal with the relationship, less with what it's made of in the media. And we are looking at what the interests of the United States are, how we see for our own interests and for our interests here in the region. We have very strong interests here in the Gulf across the board, with UAE, with Saudi, with the rest of the region. And we are going to continue to look at what are the actions that we need to take that best serve the American interests and what we think are the best security interests for this region and the economic interests around the world. That's what will guide every decision that we make.
Amos, thank you very much for taking the time. I know you've got a busy schedule, and it's been good to catch up, and I'll make sure I'll go down and fact check my $40 to $60 oil price in terms of where the cap comes. Amos Hochstein, Special Presidential Coordinator in ADIPEC 2022. My final guest, it's a wrap from the hallowed halls of where oil deals are done. Jonathan.
Hey, Manus, great work, as always.
Can we explain to the audience who Manus Cranny is?
One of the best.
He's just, I heard him on radio
The absolute
today.
best. Always
and
on
it
tour.
was that voice, it's like, Shakespearean or
That
something.
Irish accent.
Whatever it is, he's just great. It's just for
Would
those...
you like to talk about the content of that conversation?
Yeah, I would. I've never heard it. I have never, ever, ever heard this. And I want to hear from Curry, Morse, Blanche. You had Emery Descent on maybe yesterday
Sure,
on my
yesterday,
sabbatical.
Yeah.
I want to hear from adults about what I'm hearing, which is politicians talking price theory of oil. You have to enjoy losing money on oil, as I have enjoyed, to understand how bad that
And
is.
on capital return programs as well, Tom, the difference between rhetoric and policy. If you're going to sit there and say there's a limit, what's the level? What's the limit? What's the percentage that you think is right to distribute the capital returns back to shareholders, and what is wrong? And that's the difference between rhetoric and real policy. Futures right now, positive from New York. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
Well, it starts in November, this market running away to the upside on the S&P 500 up 0.9%, adding to the gains through October. Big monthly gain on the S&P, up 8% on the equal weight. S&P up 10%, best month of the year on the equal weight. On the Nasdaq right now, up 1.2% on Nasdaq futures. The underperformance on the Nasdaq 100, pretty clear for all to see through the month of October. Into the bond market, 2s, 10s and 30s shaping up as follows. Yields heading south, down 6 basis points, call it 7 on a 2-year, 441.41 on a 2-year yield, on a 10-year yield, 394.27, down by about 10 or 11 basis points. Who would have thought the weather moves the FX market? First, it was the UK, talking about a mild time and mild weather forecast in Europe in the month of November. Euro dollar positive, 0.6%, Tom, 99.38.
Yeah, fractional as well. I want to go back, John, and for Global Wall Street, this is old news. It's CFA level 1. But, John, you mentioned equal weight S&P. I think this is a really important time to talk about. S&P is good math. The Dow is a heritage index with bad math, no question about that. But the idea then you adjust for equal weight where Apple has the same weight as Colgate-Palmolive, sure, or even more. And I'm not going to go into the math now. It's the day after Halloween, but a geometric series which is even more leaden than equal weight. And all of these bear study by adults, by pros, given the gyrations we're
Basically,
seeing.
what you're doing is stripping out the muscle of big tech. To look at the S&P 500 and the average stock within it and the average stock performance. And the fact of the matter is, even though big tech in some places got hammered, it didn't bleed. I go one step further, the small caps through the month of October, Tom, 11% on the Russell. Russell 2000, really impressive. You can call it a squeeze, maybe a bear market rally, but it's there for all to see.
Lori Calvasine, RBC, leading the way on that. John, there's a headline. It's Roll Up 2023 J&J to buy Abiomed for $380. I don't know anything about it. We'll learn about it and give you the news on that. Right now, we are going to learn from Freya Beamish, Chief Economist at TS Lombard. Freya, I'm going to notice that the Bloomberg Financial Conditions Index for the United States comes in. It moves from restrictive to a more accommodative study. Now, is this Fed going into a Fed meeting with a more accommodative tone that they have to adjust to?
I think that there's a clear case to make that the outside of the Fed, that we're getting the sort of stage 1 of the pivot. I'm not sure we're quite there yet in terms of the Fed, and I think we just come back to the argument that the actual demand-supply mismatch at base in the U.S. economy is still there to be worked out. I think there's this sort of, we're getting to that stage in the hiking cycle where people are sort of thinking about, are we going to get an overshoot in the Fed? And I think it's a false dichotomy, really, because for one thing, there needs to be a recession for the Fed to actually hit its inflation target, and I don't think we'll actually ever come back sustainably to that 2%. I think the end game here is that we'll have a higher inflation target. But to kind of be moving in the right direction, we have to get the unemployment rate above 4.5%. So that's one thing. The kind of the euphemism of there has to be below trend growth. What that actually means is there has to be a recession.
Well, Freya, let's go off Phillips curve here. Ben Emmons with a smart note this morning, folks, saying we haven't met the conditions for a pivot yet. Freya Beamish, with that said, you stated they have to move the unemployment rate up. Do they have the capability to move the unemployment rate up?
This is why it's taking so long, because we're in a very different cycle here with regards to the balance sheet. In previous cycles, the Fed was able to slow the economy down through the liabilities side of the private sector balance sheet because there was that leverage there. There hasn't been a credit cycle in the 2010s. The credit cycle has been in China. The asset cycle has been in the US as a result of, if you like, the lack of the wage growth driver in developed markets, the lack of the credit driver. The result of that is that the monetary policy has been very loose. The result of that has been that there's been an asset cycle. It's been very good for the price of assets. But how do you then move from a situation where there isn't leverage to slowing the economy down? The ways in which the Fed policy affects the economy is muted. And then on top of that, you still have the overhang of the massive fiscal stimulus and the accumulation of price gains over the course of the pandemic that is still kind of sitting there in the real economy, and that sort of desensitizes the real economy to the tightening that the Fed is trying to embark upon. So they need to get unemployment above that 4.5% level, and the idea that they're just going to hit that 4.5% and then sort of move sideways is very unlikely. Partly because it needs to go above the 4.5% actually to bring the inflation target back down again, but also because they don't know how far they have to go. So it's easy for us all to say, looking back at the 70s or looking back at previous hiking cycles, that the Fed has overshot in hindsight. Yeah. But particularly in this cycle where there's so much uncertainty, they're feeling their way. They don't know how far, and they want to err on the side of dealing with inflation. So the likelihood of an overshoot, if you want to call it that, is quite strong.
What you're saying is incredibly important, Freya, which is this idea that the economy is less sensitive to rate hikes, to monetary policy, so they have to go further than naturally would be perhaps the levels that people would expect. What about the other side, where inflation is coming from? And I point to the 10.7% CPI figure in Europe. How much is due to a weaker euro? How much is due to imported inflation driven in part by the Federal Reserve?
I think a great deal. It's almost like a role reversal from what happened in the 70s, where it was the Bundesbank that was exporting the inflation, and it was the shoe was very much on the other foot. This time around, it's the US that has the imbalance in demand and supply, both in the goods market and in the labor market. And in Europe, we see some evidence of that. We can't dismiss it and say it's all imported inflation. The IMF had a good chart recently looking at the sort of the residuals of various regressions of inflation and trying to see whether that could be explained by kind of shortages in inputs and labor costs. And there is a relationship there. So we're not dismissing any kind of building heat within Europe. And I think globally, there is a key change which relates back to the value of Chinese labor and that allows wage growth to move faster. But the bulk of it has been imported inflation and the impact of this energy shock and food price shock. And we kind of said at the time when these shocks were coming through, it's going to take 12 to 18 months for this to pass through the system. And in that period, we're just not going to know what the actual drivers are. Good luck decomposing it.
Well, yeah, and I want to pick up, though, on the point that you mentioned about Chinese labor, right? The bigger context that leaves some people, including, I believe, yourself, saying that perhaps we'll have to have a higher inflation target for a bit longer simply because of some of the sort of inflationary forces, including deglobalization or regional globalization, a move away from Chinese labor that's cheap. How much is that underpinning it, and what is appropriate inflation target over the next 5 to 10 years in the developed world as a result of some of these macro forces?
Well, I think that the appropriate target is somewhere higher than 2%, whether it's 3% or whether it's higher than that. It remains to be seen. And I think probably before we get that, we'll have this sort of mirage of disinflation that will allow people to have a little bit of a tactical play in the bond space, again, on the route to that higher inflation rate. But the main kind of tectonic plate drivers here for me in terms of the global interactions are the fact that China now appears to be exhibiting the flattening of the Phillips curve that the US was exhibiting in the 2010s. So cutting a long story short, it takes more labor market tightness within China to generate that wage inflation. And that sort of tells me that this was pre-COVID as well. This sort of tells me that China has now reached that lid. And that lifts the lid on wage growth in developed markets across the world, making developed market wage growth more responsive to labor supply mismatches, of which we know there is a massive one in the US and the UK. So that's one of the drivers. And I think the flip side of that, two sides of the same coin, is that the debt cycle now moves back to the developed markets, with the banking sector balance sheet being relatively clean and the household sector balance sheet being relatively clean. That leaves space for the inflation driver of credit to return to developed markets. So you've got both wage inflation and credit inflation, and we don't have to say which one is most important because we've got them both coming back at the same time.
Freya Beamish there of TS Lombard. Freya, thank you. As always, let's pick up on a China story. Massive rally overnight in Chinese equity markets on a rumor on social media that the government in China has formed a committee to assess ways to exit COVID-0. I can tell you we've asked an official in the foreign ministry about that, and they said, quote, he is not aware of what you mentioned. So, Tom, quote, not aware of what you mentioned when asked the question about whether that committee has been formed by the government to assess ways to exit COVID-0. But that's part of the discussion and part of the reason we saw markets in China absolutely flying.
Yes, and get out the calendar. It's X number of weeks after a Congress where we saw Mr. Xi codified again for a third, and it appears endless term. And I'll say for the China watchers we talked to, John, this is right on cue, right to script.
The Hang Seng, Lisa, up more than 5%. In today's trading.
I wonder how many of these rumors are being spread after what happened with the Foxconn factory and some of the stories of people fleeing there.
Brutal.
They're brutal. People who are basically being held in a closed circuit kind of encapsulation, not provided the food that they need if they do get sick with COVID, and escaping, walking 25 miles to escape. I mean, the stories are really horrific. How much are these types of stories really fueling this shift in terms of social opinion, and then also by officials and what they're willing to tolerate?
You'd have to think that raises questions for Apple as well.
Well,
and their future in the country.
I would agree, and they've said it's going to be very hard to move out of there, but there was a story this morning about Tesla sending Shanghai workers to California to boost production because they can do better in California. This sort of speaks to Freya's point that all of a sudden that lifts the cap on potential salaries elsewhere.
Tesla also sending some workers over to Twitter. Well,
I'm not going to get into all that right now, but we can.
We can talk about that a little bit later. Futures up on the S&P by about 1% as we kick off the month of November. Doing it in the right way for the equity bulls. Julian Emmanuel coming up in about 20 minutes' time from Evercore. Looking forward to that from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden's promise to impose higher taxes on oil companies that post windfall profits will be all but impossible to deliver. His proposal comes as gasoline prices are still high a week before midterm elections. Many Democrats have unsuccessfully sought a so-called windfall profit tax for more than a decade. Now, no such proposal is likely to pass the current Senate. Russia is warning that the security of ships sailing Ukraine's grain export corridor cannot be guaranteed. And that comes after Moscow halted its involvement in a grain agreement. Russia has repeated unsubstantiated claims that Ukraine has used the corridor for military purposes. In Brazil, protests by supporters of President Jair Bolsonaro have intensified. Bolsonaro has remained silent over his loss in Sunday's election, refusing to concede defeat to Luiz Inácio Lula da Silva. Truckers backing Bolsonaro blocked the main highway linking Sao Paulo and Rio de Janeiro. Now, they said they don't agree with the results of the voting. Bargain hunters may be looking at Credit Suisse and think the bank could be the target of a hostile takeover. Chairman Axel Lehman says they'll end up disappointed.
we are going to, to strive again. So we don't have any takeover discussions, and at that point, we truly believe we want to stay independent.
Lehman spoke to Bloomberg in Hong Kong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
November 8th, as Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections.
We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune into Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Here's the certainty we're giving oil companies. We have released 180 million barrels of oil onto the market from the SPR. For our national security interest, we need to buy it back. We need to buy another 200 million barrels back over the next several years. We have said, the president himself has told companies, I will tell you what price I will buy it back at $70 or so. I will start buying back at large amounts.
Amos Hochstein there, the special presidential cohort from New York City this morning. Good morning. Equity futures up by almost 1% on the S&P 500. Quite a tidy rally to kick off November off the back of some big gains in October. Futures higher on the S&P. Yields a whole lot lower, down almost 10 basis points on a 10-year, 394.68. That bears watching. In the FX market, euro dollar 99.34, up 0.5%. And it's a story at the moment, isn't it, TK? 87.94 on crude, up by 1.6%.
I work off Brent crude because of the war, 94.37. I'm going to call that $2 down from the latest uproar and $24 or so down from where we were what seems long ago and far away. Short term, 1 week out, and we will be in Washington. Anne-Marie Horton joins us, of course, our Bloomberg Washington correspondent. Anne-Marie, I just went out and looked. In Pennsylvania, manufactures 13,000 barrels of oil per day. How did the president's comments not play in Texas or Oklahoma? They're forever and gone Republican. How did his comments play from Scranton to Pittsburgh?
Well, Tom, you can really make the argument that he came out and made these comments because we're a week out from the midterm elections. And the Wall Street Journal this weekend really made a valid point, which is the fact that gasoline prices have dictated the president's approval rating. So gasoline prices go up, the president's approval rating goes down. So this was really a political speech. It was short-sighted when it comes to the policy, because we all know that Congress is not going to be able to enact a windfall tax. They actually flirted with this idea months ago, wasn't able to get through. This Congress wasn't able to carry the Kerry loophole when the Democrats were able to pass legislation and they have control of the Senate and the House. There's no way they're going to be able to pass a windfall tax. What the president was trying to do, though, was off of these mega high earnings. I mean, just look at Exxon alone, $7 million an hour is what their profit ended up being. He's using this at a point to scapegoat the oil companies and point blame for the fact that Americans for the past few months were dealing with higher energy costs.
So what are the policy options for the administration? What are the viable, realistic policy options available?
Well, the president said yesterday he's calling on this tax. As I mentioned, that's likely not going to be possible. Another issue that a policy has been floated was to basically have an export ban of fossil fuel products, not crude, but actual products like gasoline, diesel, etc. And, you know, the timing of this speech is not just so interesting because of the midterm election. It's interesting because we're going into the winter, and something that's not really making the front page news the way your local gasoline price is going up or down is the fact that this nation right now is incredibly low on diesel stockpiles. And there are some places that are even dealing with emergency measures when it comes to diesel. So, Jonathan, I mentioned this because another policy they might be doing is something to do with stockpiles and asking private companies to increase their stockpiles, especially on the East Coast.
Lisa, Steve Shork absolutely nailed this call.
Yeah, people have been
lights out.
Yeah, people have been talking about diesel for a while, and the concern especially having to do with heating homes heading into a winter where we still haven't heard the meteorologists come out and prognosticate quite yet about the U.S. winter and how much it's going to be colder or warmer than people expected. How much the Republicans are proposing on the other side? I mean, how much is the main linchpin of the Republican talking point? We're better than them because we're not in power, but also really a restriction in terms of exports, that being front and foremost, perhaps a bid to remove some of the aid to Ukraine, remove some of the presence with respect to sanctions?
Well, I think when it comes to the Republicans, something that they really hammer the administration on is the fact that, and Jonathan mentioned this earlier, the president ran on a campaign that he wanted to put an end to fossil fuels. And the Republicans are saying is, okay, you can tax them, or you can make an incentive for these companies to boost more production. When it comes to aid for Ukraine, Lisa, you know, right now, at the moment, there is still a majority of bipartisan support of supporting Ukraine. But, you know, we've been talking about for weeks that there are a little bit of questions coming from the likes of Kevin McCarthy saying there's not going to be a, quote, blank check for Ukraine. Then, of course, we had that progressive Democrat letter that was then retracted. But that was really outlining the fact that if tens of billions of dollars are going over, maybe it should also mirror a concern down the road. And this even means with Russia that at some point there will be a diplomatic path forward.
MH, I want to go back to a letter that was written by Democratic senators to the former president in March 2020. And I want to bring you a quote from it. as well. Here's one quote from it, and you can all find that letter. It's available online from Senator Markey and others as well. This is how it reads. I'll read it as follows. And it truly is, to go back over this is just shocking. The increasing affordability and prevalence of renewable energy technology provides a cleaner, cheaper alternative to oil, illustrating the recklessness of investing taxpayer money in what will likely become stranded assets. Can we just go over that again? Illustrating the recklessness of investing taxpayer money in what will likely become stranded assets. At the time, the former administration wanted to refill the SPR. Anne-Marie, at the time, you had Democrats telling the former administration that any investment of taxpayer money into the oil patch was reckless because they would become stranded assets. Now, why is it not right to hand that money back over to shareholders? Because aren't they basically agreeing with the Democratic senators of 2 years ago?
Well, they are, and this is the big debate and the pushback and the criticism you'll get from the industry. You are running and you verbally talk about and socialize and running campaigns on the fact that you want to get rid of our industry. And now you're asking us to produce more. And what oil industry will say is that you cannot just overnight have more refineries or overnight produce more oil. This takes years, months, sometimes decades long of planning. And what the administration's entire communications towards the industry has been, at some point, we want to transition and we don't want your assets anymore. And actually, Jonathan, even there's some who say that, well, if there's higher oil prices and there's market demand, maybe then more people will buy EVs. Isn't that what the administration wants? The big problem the administration has is they went into their entire 4 years, the administration going into their leadership, not really realizing, and no one could predict, the kind of energy crisis they were about to have. And their rhetoric did not match the moment.
AMH, thank you. Anne-Marie down in Washington, D.C. I don't think we've heard the end of this, have we, TK? As soon as the headlines dropped the other day, Lisa and I were talking about it. As soon as we got Exxon, as soon as we got Chevron, we both said the same thing. As soon as that dropped, we were waiting to see what the president would have to say about it.
It was basically, and you? What's your response?
Yeah.
That was
What have you
basically
got
what
to
it was
say
saying.
about
Yeah,
it?
exactly.
And now no one believes the threat of the policy initiative that the president was dangling over the oil companies yesterday.
Yeah, my only comment is it's a war, which is a huge variable. Everybody I talk to says if you get demand to click in, read an opening of China, up we go. Maybe that works, maybe it doesn't. I want to see a cogent walkthrough by Curry, Blanche, Morse, Amrita Sen, the rest of them on the microeconomics around what we're hearing the politicians state.
Julian Emmanuel of Evercore is going to join us around the table in about 5 minutes' time. Looking forward to that. Futures up by around about 1% on the S&P. From New York on TV and radio, this is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
People are talking more bearish than they're actually investing.
Inflation will prevail above Fed goal. I don't think that far above goal.
For our base case, we still think that the Fed might end somewhat below 5% policy rates.
They don't want to break anything. What the Fed always wants is to see what have their actions done.
The central banks have been wrong before.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
You know, we've gone the whole hour without saying step down. Not once. I don't even think I've said the Federal Reserve once either.
Ben Emmons said
the Fed once either.
On the record, you're the one who first brought it up.
So if you're just tuning in on Bloomberg Radio, you missed it. From New York City this morning, good morning, good morning. For our audience worldwide on TV and radio with Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow, counting you down to a Fed decision and all that step-down chat. Futures up 9/10 on the S&P. TK, what a rally we saw in October. It spills over to November this morning.
Confounding the gloom crew, the equity market's up. I think there's too much made of the Dow, big month and all that, quality, big caps.
Wait, hold on a second. What?
Who's making what of the
No, I think everybody in the zeitgeist, I'm Dow first, but everybody in the zeitgeist is way overemphasizing an historic month for the Dow, and the real news is the underperformers lifted as well.
Okay.
It wasn't just the Dow. You mentioned small cap up, even the NASDAQ with a lift. The Dow out to 33,007 on futures this morning. Julian Emanuel knows all that matters is the Dow.
Julian's alongside us. Julian, just quickly, do you even have a Dow forecast year-end?
We don't, but I'll tell you, my father-in-law worships the Dow.
There you go. There we go.
Do you offer him a private forecast just for him?
Anytime.
Futures right now on the S&P up 8 or 9/10%. Let's rip through the price action. Yields lower by 9 or 10 basis points on a 10-year, 395.10 on a 10-year yield. We'll talk about the weather in Europe, and I tell you, it's a bright spot. The weather forecast for November, a milder November for the Europeans. Euro-dollar 99.34, up 0.5%. And the controversy, TK, in the oil patch right now, 87.90 on crude, up by 1.6%. And a president that sounded fiery yesterday evening.
It becomes the domestic politics, and there's different oil discussions right now. Right now in Kyiv and in Ukraine, it's survival of being dark, being without water, being cold, even in the 40-degree weather. Here, it's a different story. And I go back to what I mentioned to Anne-Marie Horton. I didn't know this. Pennsylvania still, Pennsylvania was oil. Rockefeller and over into Ohio, John Hay and Cleveland. And the answer is they still do 13,000 barrels a day. How does his rhetoric play in the Pennsylvanias of the world, frankly, in Nevada?
Just bring up fracking in that debate.
Yeah.
Over in Pennsylvania. Very, very different conversation. Brent crude with a 94 handle, Lisa. The oil patch a big discussion for us later.
Very much so, and we are getting a slew of earnings today and throughout the week from the oil patch. So we'll parse through those to see just what the earnings are, what the blowback is, and honestly, what the investment is at a time where people are saying we really need that to be sustainable over the short term, even medium term, before we get to some sort of greener future. Today, the earnings that have been dropping, Uber just came out and actually beat expectations, although it did put out a projection for the fourth quarter that was disappointing. Those shares surging more than 9%. And if you dig into some of the release, it's interesting to hear about how the actual driver base increased dramatically, and they went back up to volumes going back to 2019. This highlights that people still have money to spend, whether it's ride sharing, whether it's on food delivery. Airbnb will be reporting after the bell, as well as a slew of other earnings. We're going to be hearing from SoFi Technologies how much consumer lending is happening as the economy is still good. Simon Property Group, Devon Energy talking about the shale patch, Mondelez International, a whole swath, about a third of the S&P 500 reporting this week. Today, the Bank of England will become the first major central bank to actively sell sovereign bonds held on its balance sheet, about 750 million pounds of short-dated gilts. What an effect will that actually have on two-year gilts that have been completely hinged to whatever fiscal projection they have from Rishi Sunak, as well as what the Bank of England does on Thursday. And at 10 a.m., U.S. ISM manufacturing for October, construction spending, and JOLTS job openings data, John, all coming out. ISM manufacturing, it's expected to come in around that 50 level, right, which doesn't mean a contraction or an expansion. If it comes in below that, what does that mean? And if it comes in above that, how do people grapple with the potential for supply chain disruption starting to ease a little bit, manufacturing actually seeing a bit of recovery at a time when perhaps that's not what people want to see with respect to the Fed and their policy?
Elisa, thank you. Looking forward to the data a little bit later this morning. Does Devon Energy whisper their earnings this morning on the call, Tom? Just say it really, really quietly. These are our capital returns.
Yeah, I think there's some of that. You know, Mr. Dudley of BP was with Manis in Dubai, as we heard from the administration's Amos Hochstein, and there is top to bottom, from Total on down, there's a reticence to talk about it.
Julian Emmanuel with us around a table from Evercore. Julian, wonderful to have you with us. A proper introduction, sir, which you deserve. What a rally we've just seen in October. Spills over to November this morning. We asked the guest a little bit earlier, Eric Freedom, what he thought of it, and he said he'd fade this. Do you agree with that?
No. From our point of view, look, the next week or two could be very choppy. Obviously, you've got the Fed tomorrow. You've got the elections next Tuesday. And there's likely going to be back and forth as we've seen the last couple of days. But from our point of view, look, we know the Fed is about to downshift. I don't want to call it pause. I don't want to, whatever. But we know the trajectory is going to change, and the market is getting comfortable with that. At the same time, just like the July earnings season, we know the numbers are coming down, okay? And it didn't matter stocks in July. And it doesn't matter now because, frankly, people have been, for the most part, underinvested. And the last thing, the stock-bond correlation. You can't get away from that. The UK set the line in the sand when we resolved the political issues that at least stopped the parabolic move up in yields. And that's supportive for stocks.
We've got you for the whole half hour, which is a real pleasure. I want to go into some of the machinery of what you're doing day to day that everybody on Wall Street's reading. We'll do that later. Right now, you have a single statistic the morning. It keeps coming up. Revenues keep ticking up on your earnings edge, 9.5%. What's the glide path of revenues you see with your optimism into, say, June of next year?
Well, again, look, we know the story is the story that none of us as adults have faced in our investing lifetime, and the revenues are being driven by the ability to pass on prices in an inflationary environment.
Coca-Cola, we saw that with Coca.
Absolutely, absolutely. Look, the glide path is going to moderate. The question is, can margins be maintained? They've slipped. There's likely going to be some more slippage, but can we maintain? And that's really the question confronting corporate America.
Do politicians want to see those profit margins maintained? As the Federal Reserve, in other words, the more that profit margins are maintained, the higher rates will go at a time when there is the lack of sensitivity right now between monetary policy and the market response.
Look, this, again, is part of the narrative. There are a number of ways that policy tightens, and And certainly, and again, this is part of the dialogue we've seen in the last 24 hours in pointing out the energy industry in particular, that we do want to see margins come in. But again, this is why the challenge of the soft-ish landing is so intense, because there's a lot of things that have to go right.
Triple leveraged all cash fund, I have no tax losses, okay? Other people have a lot of tax losses. How do you play the shell game of tax loss candidates into January 3, 2023?
So we are very strongly convicted in the idea that you don't want to take money out of the market here, okay? Look, could we go lower at some point next year? Absolutely. But that is contingent on, we've moved from contingent on a recession to contingent on a deep recession.
Bloomberg Radio, you don't see this, but they put a manual over here with me because Lisa just didn't want to sit next to that much optimism.
Too constructive?
Too constructive.
Lisa will say, though, the consensus view, though, has shifted so much, Julian. We've gone from the Fed's not going to hike too much to it's not going to hike 50, it's not going to hike 75, or maybe it won't hike 75 again. They're set to do a fourth 75 basis point hike. When it came to the recession, it was no recession. Now it's a recession, but short and shallow. We're a long way from where we started the year, Julian, and we've been wrong the whole way through 2022. What gives you any confidence about 2023?
Look, we do have to understand the fact that when you have a year like 2022, both the left tail and the right tail, and you know we talk about options plenty at Evercore ISI, are very large. And frankly, when you look at it, and this is one of our favorite graphs, the bond stock return quadrant, it's been the lower left in an unprecedented nature over the last 60 years, 2022. But actually, the upside of that is the year after the only other time it was lower left, 1994, you had a massive return year for both bonds and stocks. And again, we respect the concept of seasonality. It's not the be-all and end-all in the markets, but we all know the data that supports good years after midterms.
Can we give Hyman a shout-out just quickly? Did you see the latest Institutional Investor Survey? Ed Hyman, top economist, a title he has earned 42 times in the 51-year history of the Equity Research Survey. I mean, I'm sorry, 42 out of 51.
Yeah. Well, this is what you go. And, you know, he's smart enough to hire Michael Chu and Julian Emanuel. You work for Chu, right? That's how it works. We'll talk about that later.
That's how it works.
But the basic idea here, John, he's been doing it since C.J. Lawrence, and here's how he does it. Granularity. No one is as granular as Edward Hyman. He's got a black pencil. He's ruined 3 of his light gray suits. He's got the Sharpie thing going. He ruins like 3 suits.
He uses a Sharpie.
Uses a black Sharpie on his nose.
That's the secret.
And he's got he's looking at railroad crossings in Kansas City.
This is value add.
This is real value add.
You just take a Sharpie and you talk about railroad crossings. You get number one.
Secrets.
Yeah, exactly.
I had a deal once. I had a deal once, and I had a paragraph on page 42 that said if I didn't get Ed Hyman's literature, I wouldn't work there.
I was trying to give Ed a proper shout out, and you just went on a rant about pencils and Sharpies. Julian, I'm pleased to say you're going to stick with us. Julian Emanuel of Evercore.
Like, I'm not sure if I am.
Stand around the table with us. Your equity market shaping up as follows.
Talk about Michael Chu.
October, up 8% on the S&P. November, equity futures looking good, up 0.9%
Dow,
on the S&P.
33,000 print.
Julian talked about that correlation between bonds and stocks. Treasuries rallying, yields down by 10 basis points on a 10-year. From New York on TV and radio, this is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers are expected to raise interest rates another 75 basis points at the end of a 2-day meeting that begins today. It's the Fed's most aggressive tightening campaign in 4 decades. Still, some strategists believe that this stage of rate hikes is at an end, and the Fed will begin smaller increases next month. In the UK, Rishi Sunak's government says it's inevitable that all Britons will have to pay more taxes to restore stability to the public finances, especially the richest. Sunak met with Chancellor of the Exchequer, Jeremy Hunt, on Monday to discuss the budget. Now, according to the readout from the Treasury, they agree that tough decisions are needed on tax hikes and spending cuts. North Korea is threatening the U.S. with what it calls powerful measures if the American military doesn't end exercises with South Korea and others. The rhetoric may be an effort by Kim Jong-un to lay the ground for his first nuclear test in 5 years. Now, this week, the U.S. and South Korea started joint air drills after exercises on land, sea, and air in recent weeks. And a big takeover in the medical device industry. Johnson & Johnson has agreed to buy Abiomed in an all-cash deal that has an enterprise value of about $17.3 billion. Now, Abiomed develops technologies designed to assist and replace the pumping function of the heart. And under a new owner, Elon Musk, Twitter limiting content enforcement work just before U.S. congressional elections. The social network has frozen some employee access to internal tools that are used for content moderation and other policy enforcement. Now, that's affecting the staff's ability to clamp down on misinformation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
These CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer Wednesday on Bloomberg. season is here.
The earnings are starting to pour
The
in.
numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going across the wire.
A big beat.
Stock is up more than 8%.
Coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch?
That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We've never had a recession where jobs were growing. So if jobs continue to grow, we're not in recession, yet it's still the case that the Fed policy works with a lag. So if they keep raising the interest rates like this, eventually we are going to see a significant slowdown.
Austin Goolsbee there, the former chairman of the Council of Economic Advisors from New York City, counting you down to the opening bell to kick off a trading month of November with equities positive on the S&P once again. Big month of October, futures up by 0.8% on the S&P, and the bond market yields lower by 10 basis points, 394.48. The weather better, milder in Europe. That's the forecast for November. Euro dollar 99.29, up 0.5% there, and just a massive rip-roaring rally over in China. Rumors going around on social media that the government was putting together, forming a committee to assess ways to exit COVID-0. We asked one official
Did anybody
in
say
the Chinese
science?
Foreign Ministry, and that official said he's, quote, not aware of what you mentioned.
Yeah.
So that's where we're at with Chinese equities right now. And Tom, they had a massive move in today's session.
Yeah, of course, off a really difficult time here. Renminbi 7.26 yuan per dollar. I'm going to digress here with Julian Emanuel, Chief Equity and Quantitative Strategist at Evercore ISI. John Farrow and Lisa Bramowitz want to do the market talk. I want to do for Global Wall Street right now the brilliance of how sausage gets made. And of course, this is under the guise of Ed Hyman, the giant in economics at his ISI. Julian Emanuel, you show up, you do the media turns, smile and all that, while Michael Chu and his team is back at Evercore ISI on Park Avenue grinding away. How do guys like you do what you do with animals like Michael Chu?
Well, basically, it's like everything else. It's football. It's the financial industry. It's politics. It's whatever. You have to have a great team. And you're only as good as your weakest link on the team. And frankly, it's sort of, you cook the soup, you come up with ideas, and you think about how to execute them. And fortunately, we've got a terrific platform.
Do you guys argue a lot about the market view, or are you like the dictator that says this is what we believe?
No, you have to take in opinions and viewpoints. And I will tell you that working with people younger than I am, and look, the last 2.5 years,
right.
If we don't learn from millennials, you've missed a lot because the perspective is different. Let's think about it this way. We are affecting politics. We're affecting world outcomes on Twitter 24/7.
Okay, let's get it back on the rails of the surveillance conversation.
Sure.
We now have a risk-free rate. Taleb says the gravity's returned to the market. Do the young Turks like Michael Chu have any understanding of what's coming with the new risk-free rate?
Actually, surprisingly, the metamorphosis is much quicker and much more profound than I would have thought. And I think that also explains why the retail investor stays engaged. And something that we're seeing that's different now is this transition from simply owning stocks to actually owning call options plus cash. So you've got your leverage, and then you put your cash, and you're getting 3+% on it, which is why the markets are supported in a manner of speaking.
So people have been coming on the show all year and been saying it's time for stock picking, right? Because of exactly what you've been saying. Time for bond picking. And then I was looking at the returns, and bond funds that were actively managed have underperformed by the greatest margin for years when you take a look at the broad bond index. So why has that been so difficult if it does seem clear-cut that there are certain secular trends that make certain stock picking successful?
Well, I think you have to disaggregate stocks and bonds here, because what we've seen is actually in this environment, the VIX is lower than we might have anticipated on balance for a down 25. You never spiked over 40, whereas the Treasury Volatility Index has been at the all-time highs for a long time. It's been much more destabilizing in terms of liquidity and in terms of, again, security selection at the bond level. that's going to dissipate.
So when you talk about the gravity being back in the market, as Tom was saying, are there areas that are just not going to come back in the same kind of way? And I point to big tech, right? This question of whether we just witnessed the big expansion and deflation of a tech bubble that is not going to drive the economy in the same kind of way.
It's not a bubble. This is not like 2000. However, when you think about it, over the last 10 years, we've gotten to this point where the returns were driven by a handful of stocks, FANG Plus, whatever, which got to maxed out at almost 25% of the way to the S&P 500. What's likely going to happen is that, and you've seen it from time to time in components of FANG, they just go sideways while earnings catch up to valuation, and then they make the next leg higher. Long term, those are still secular growers. They're just not going to prop the market to the extent that they have.
And this raises a question about, again, the idea of risk-free rate actually being something, right? You actually have a real yield in a way, and people could argue over whether you actually do or not, but at least when you take a look at some of the metrics that are traditionally looked at, how much does that eliminate buybacks and some of the financial engineering that supported the stock market for so many years? How does that kind of bleed into valuations?
Well, it certainly, it's going to change the discourse between how companies allocate their capital, but you're still in an environment where the good companies in particular, and that has bifurcated to a greater extent this year, are throwing off tons and tons of cash. Buybacks are not going to disappear. It's just going to be a weapon that's probably going to be deployed more judiciously, let's say, and where you're actually going to return to a strategy of buying low and buying less high.
And get you in trouble politically. Down in DC, apparently. If you're in the oil patch, I think it's okay if you're a tech company. Is it okay if you're a tech company?
It depends which tech company, I'm sure.
Well, if you have really fat margins and you also have a monster capital return program, is that okay?
It depends, because if you have then a company that's buying up all the competitors and you have an antitrust push, that could potentially be
What if all your production's in China and you have these really fat margins that you get from American consumers, and you've got this monster capital return program?
I'm not sure who you're talking about.
No idea.
Sure, yeah.
When does the Christmas tree index come out? When does the Christmas tree index come out at Evercore? When do we get that?
Very soon. We already got a date for the party in person this year, which is very exciting.
Great.
So
awesome.
I'm dazzled. I learned a lot from this conversation today, and particularly your father-in-law loves the Dow.
Loves the Dow.
That's what I learned.
I mean, that's heartwarming.
Well,
I'm going to tear up here.
91.5, and he stayed fully invested the whole time. Unbelievable.
That's the number one. Folks, on Bloomberg surveillance for the next 100 days, that's the most important thing you could hear.
I was trying to thank Julian 30 seconds ago. You couldn't help yourself, could you?
No, I couldn't help myself. Julian Emanuel's father-in-law loves the Dow Jones.
I'm sure he does. It's the boomer index for a reason, Tom.
Boomer? A 91-year-old's a boomer? Please.
Julian, good to see you, as always. From New York City, good morning. I'm sure I've offended half the audience. Features up 9/10. This is Bloomberg.
do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency.
To really get things done for yourself and control your own destiny, that without it.
Hello, I'm Emma Barnett, and I'm a journalist and presenter. This is my new show, Emma Barnett Meets. First, I'll be meeting Chinese artist and dissident Ai Weiwei, and I'll talk to the novelist and political scientist Elif Shafak. Tune in to watch those who shape our world explain how the world shapes us. This is Emma Barnett Meets on Bloomberg Quicktake.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Two hours away from the opening bell, equity futures positive across the board here on the S&P, on the Nasdaq, on the Russell. I'm sure the Dow is too. Futures up by 0.9% on the S&P 500. What a run we saw in October, up 8%, just clear underperformance from the Nasdaq. The Nasdaq 100 up almost 4%. The Russell, the small caps, up 11%. Biggest monthly gain on the small caps going back to November 2020. What a run. In the bond market, guess where bonds are? Yields are lower, 11 basis points lower on a 10-year, 390, 366. Where's that come from? 2-year, down 5 basis points, 443. A few Fridays ago, about 2 Fridays ago, we had a look at 460 something. Now we've backed away, down another 5 basis points on Fed decision eve, and a conversation about